Hi students, I am Prakash, Chartered Accountant and acting as academic advisor in Masterminds from the past 20 years. Here is a short video introducing matchless Masterminds briefly for the convenience of the students who came to this channel for the first time. Masterminds was established in the year 2002 and has been acting as a reliable platform to offer coaching for CA and CMA courses. Masterminds is undeniably the pioneer and the leader in MEC, CEC, CA and CMA courses with nearly 20,000 admissions per annum. This is an incredible initiative by three edupreneurs, namely Mohan, Radha and Prakash, that is me. All three qualified CA at a very young age of 21 years and started this organization under the mentorship of my father, Mr. M. Siv Prasad Garu. So Mr. Mohan is my brother and Radha is my sister-in-law. And by the way, it's me, Prakash, Chartered Accountant. So here are the courses for which we offer the coaching. We offer coaching for MEC, CEC groups exclusively at intermediate level. And we also offer integrated coaching for MEC along with CA-CMA Foundation. And we also take exclusive admissions for CA-CMA Foundation or CA-CMA Inter. And we also offer coaching for CA-CMA final level as well. Recently, we have started a unique academic program at intermediate level, that is MEC Pro, aiming for the students who want to pursue BBA or MBA or CLAT courses in future rather than CA or CMA, and we have received a huge applause for the same. So 20 years of experience, and we have finished more than 155 batches of CA or CMA Inter in Guntur alone and similar number of batches in all our branches together. So till now completed 17 batches of CMA Inter and 18th batch is going on. Successfully completed 25 batches of CA final till now and 26th batch is running now, and we have also successfully completed 4 CA or CMA final batches in Hyderabad. So till now our students are able to achieve 990 All India ranks at various levels of CA-CMA courses, and our students are able to achieve first rank for 48 times in various courses for which we offer coaching. So in a single year our students are able to achieve 3 All India first ranks in the year 2020, and till now our students are able to achieve state first rank at MEC intermediate level for 18 times, that too 8 times in a row. In a single attempt, our students are able to grab 98 All India ranks at CMA Inter and final results of January 2021 and our All India ranks in February 2022 CA results. And here are the 10 All India ranks in CA final results of 2021 alone. And till now our students are able to secure 93 All India ranks at IPCCR CA Inter level in the last 9 years. And here is our physical presence: Guntur, Vijayawada, Hyderabad, Amirpet, Dilshuk Nagar, Vizag, Tirupati, Kurnool and Rajahmundry. And here are the locations where we have branches, and here are the contact numbers. Here is the list of our physical presence and here is the list of our online presence. And for your kind information, we don't have branches in any other locations other than stated here. So please do install our Android app Masterminds Online Classes from Google Play Store, and if you belong to iOS platform, then install an app called Class Plus from Apple Store and enter the organization code as MZGUN. In this app, you can find a large number of useful content like regular batch videos, crash batch videos, rapid revision batches, guidance classes, motivational videos, amendment videos, Masterminds test series, whatnot. Large amount of useful content is already available in the app. In our app, you can find a section called study material where large amount of free content is also available, and till now more than 24,000 students have already downloaded our app and we are nearing to 25,000. Sir, is it possible to interact with the directors directly? Yes. If it is an administrative issue, you need to contact Mr. Mohan sir on this mail ID. If it is academic issue, you need to contact me on this mail ID. So thanks to all our students who are our true brand ambassadors and who helped us to reach this position. All the best.
Good morning, everybody. Hope you are all fine and safe. Let us start the discussion of the RTP, the latest RTP applicable for this May attempt. So, let us start discussing one by one. Okay. First, question number 1. It is relating to dissolution of partnership firm. Sir, one thing I would like to communicate. It's not possible for us to write the solution for each and every question and then discuss in detail because the time is limited. What I will do is I'll open the solution simultaneously and I'll discuss with you. That's all. I am not going to write each and every part of the solution. So hope it is clear. Let me start reading the question. Now this is based on the dissolution of partnership firms. The firm of Messrs. Om has 4 partners A, B, C and D as of 31st March 2021. Its balance sheet should as follows. Okay. Capital account balances was given. Current account balances was given. We have taken a loan from an NBFC that was given. Current liabilities was given. Land, building, office equipment, computers, data, stocks, cash and bank, other current assets, current account balance of D also. There is a negative balance for D. Now all these information was given. Okay, right? Now, next. The partners have been sharing profits and losses in the ratio of 4:4:1:1. It has been agreed to dissolve the firm on 1/4/2021 on the basis of following understanding. Sir, dissolution is being happened. Now, whenever dissolution is there, now we have to close the books of accounts. For that, what are all the ledger accounts we usually open, sir? Now, one, we open the realization account, then we open the partners capital accounts. Hello, one is realization account, then the other one is partner capital account. Here you are having current account also. This current account balance itself, what we will do, sir? We will transfer to capital accounts. I think you remember that. So in that way, and finally cash and bank, like that, these are the minimum accounts that we will prepare. Okay, let me start dealing with one by one, sir. Let us look at a point and then incorporate in the corresponding place. For solving, first what we should do, we should open all these accounts simultaneously. First realization account. Anyway, look into the question, you will have clarity, sir, what they are asking. Assuming that the realization of assets and discharge of liabilities is carried out, immediately show the cash account, realization account and partners capital account including their current accounts. They are only asking these 3, sir, cash, realization and partners capital. We will open the formats of all the 3, realization, cash, partners capital as well as current accounts, and then we will start recording one by one. Okay, right. Let us start recording, sir. First, what we will do, sir, we have to record all the opening balances. Now, capital account balances, where we will record, sir? We will open the partners capital account. Hello, we will open what, sir? Partners capital account. In that, we will record the capital balances A, B and C. It is 2 lakh, 2 lakh and 1 lakh. Okay. Next, current account balances was given. Of course, D was negative. That we will write down in current account balances, sir. A, B, C and D negative. We have written 2 balance brought down. In this way, we will write current account balance in the current accounts. Next, because all assets and liabilities are to be closed through realization account, now all these assets we will show in the realization account. We will open the realization account. In that we will start recording all at book values, land, building, office equipment, then computers, debtors, stock, then other current assets. You could observe here other current assets. Then, sir, hope you are understanding. In this way, we will write all the assets we are having. Sir, what is to be realized, we have to write in the realization account. So, cash need not be realized, no. So, it's an asset which is already available. So, you need not write specially cash balance there. If you write other assets, it is sufficient. It is just for closing the books of accounts. We will write land, building, office equipment, computer, debtors, stock, and we have written other current assets. Cash and bank, where we will record, sir, because we are maintaining an account, we will write down in cash and bank account, 2 balance brought down 75. Like that, in all these accounts, we will write the corresponding balances, opening balances. Is that clear? This we have to record in capital account. This we have to record in current accounts. All these items we have to record in this item also we have to record in realization account. Cash and bank we will record in cash account. In this way, first we will write the opening balances. Next, let us see the transactions one by one and post in the corresponding places. The following assets are to be adjusted to the extent indicated with respect to the book value. Land, we have to take land we have to consider 200%. So we will write in the realization account by cash, because we assume that all these amounts will be realized. 200%, so 50,000 into 200%, which gives you 1 lakh. Next, building 120%, so 50,000 into 120%, sorry, 2 lakh 50 into 120% gives you 3 lakhs. Similarly, computers 70%, so 70,000 into 70%, 49,000. Then debtors 95%, so thereby 4 lakhs into 95%, 3 lakh 80. Similarly, stock 90%, 3 lakh into 90%, 2 lakh 70. Then you may get a doubt, sir, they have not given anything with respect to office equipment and other current assets. So if they mention specifically, we have to take that values. If nothing is mentioned, we will take the book values only. We will assume the same value is realized. That's why office equipment is at 1,25,000, other current assets is at 22,600. If they have given any value, we will write that. If they have not given, we will simply write the book value. Now next step, in the case of loan, the lenders are to be paid at their insistence a prepayment premium of 1%. Sir, if the loan is paid early also, sometimes they may collect some extra amount. Why, sir? Because you are repaying early, they have to find another customer to give it as loan and start earning their interest. So it takes some time. So thereby they will charge some penalty as a percentage. So here you could observe, loan is how much, sir? 5 lakhs. Now we have to pay premium penalty of 1% also. So it is 5 lakh, 5,000 is the payment. Now, have they said anything about current liabilities? No. Then we will assume that book value only settlement was done. In this way, we have to record the settlements. Hope everybody have understood. Now, once you have done all these things, you will get the profit or loss. No, because you have recorded everything. Every item was settled. Now, what you will do? You will find the realization profit or loss. Now, in which ratio you will divide, sir? The profit ratio given in the question. So, what is the profit ratio given, sir? 4:1:1. In that ratio only we have divided the profit on realization. Where we will transfer, sir? We will transfer to current accounts. So to the current accounts we have transferred the realization profit. Once we have transferred the profit, now we will transfer the balances to, we will transfer the balances to capital accounts, because we are closing the books of accounts. Whatever balance existing here, you could observe, A, there is a credit balance. This we will transfer to partners capital. B also, this we will transfer to partners capital. C, this we will transfer to partners capital. D, this we will transfer to partners capital account. In other words, the closing balance of the current account is to be transferred to partners capital account. So in the partners capital account, we will write this current account balances, current account transfers. Hope everybody have understood. Next, what they have given, sir? D is insolvent and no amount is recoverable from him. Now, if you observe, what are the balance of D, sir? Only 85,000 debit balance. Now, he is telling that I cannot bring the cash. I am insolvent. Okay. His father C, however, agrees to bear 50% of his deficiency. What is this deficiency? 85,000. Who has agreed? His father only, C. So, what we will write? By C account, we will show that this much amount is receivable from his father. By C account, 42,500. 50% is borne by C. That's why we have debited C. Okay, sir. What about the balance? The balance deficiency is to be agreed apportioned according to the law. What is the law? Garner versus Murray rule maybe. In that you have to apportion in the capital ratio. In the ratio of their capitals only, you have to allocate. So, what are the capitals? Balances you are having, sir, at the beginning 2:1. In that ratio only this deficiency has to be borne. So if I reduce this much, what is the deficiency balance, sir? 42,500. That has to be apportioned in the ratio of 2:1 It is capital balances ratio, sir, Gardner versus Murray. So thereby, once you distribute in this manner, automatically we will record these here also. Hello, is that clear, sir? Now in D account, we will write by C. Here also in C account, we will get 2D. Now these deficiencies, when we write here, automatically it will be reflected in their corresponding accounts. Sir, is that clear, everybody? Who is C here? D's father. That is what important. C is also a partner, but C is D's father. In this way, the apportionments are being done. Once the apportionments are done, everything is over. The balance amount, we settle them in cash. So thereby, whatever pending amount is there, closing balance, the balancing figure, this we will write as to cash. In your cash account also, cash and cash ledger account, we will write whatever the assets realized, that is 12,46,600. Opening balance anyway we have written. Liability settled we will write down. What this 5,75,000. Now whatever we have settled to each of the partner we will write down. Automatically it will tally. If cash account is tallied, whatever you have done is correct. In this way, the ledger accounts has to be prepared. Is that clear, sir? Very simple question. We'll just write the settlements. If nothing is given, we have to settle at book value only. Then current accounts has to be closed by transferring to capital account. If a person is insolvent, his deficiency has to be borne by the other partners in the capital ratio. So this is what the discussion. Hope everybody have understood. Let me move to next question. LLP, based on LLP, they have given a question, sir. Explain the nature of a limited liability partnership and under what circumstances an LLP may be wound up voluntarily or by the tribunal. Now you could observe, sir, some basic information will be given. First they are asking nature of LLP. An LLP is a body corporate formed and incorporated under LLP Act, and it is a legal entity separate from that of its partners. Hello, it is a legal entity separate from that of its partners. A limited liability partnership, that is LLP, shall have what? Perpetual succession, just like a company. And any change in the partners of LLP shall not affect the existence, rights or liabilities of a LLP. That is what the point. Sir, basic information only, you read it, you will understand. Next, when an LLP may be wound up voluntarily or by the tribunal. Now, some circumstances is given. Usually, the number of members should be minimum 2, sir. If at all the number of members is not 2, below 2, then definitely they have to wind up. If for a period of 6 months, the number of partners is below 2, you have to be wound up. If LLP decides that it should be wound up by the tribunal, LLP itself is deciding that. Sometimes if tribunal is of the opinion that LLP is wound up, then also that means voluntarily okay, or if tribunal feels that, then also okay, or LLP is unable to pay its debts, or it has acted wrongly against the interests of the country, or it has defaulted in filing any statement of solvency for the registrar, like this, for any defaults or any voluntarily or tribunal for a proper purpose. In all these circumstances, an LLP may be wound up. Sir, theory question, just have a look at that, you will understand. Already you might have prepared in the regular sessions also. Now next, let me move to question number 2. This is advanced issues in partnership, sir. Sale of partnership firm to a company. Let me read it. You and we were in partnership with sharing of profit and loss equally. The firm's balance sheet as at 31st December 2021. When this balance sheet was there, sir? 31st December 2021. For 9 months was, they have given some balances. Partners capital accounts, UV 1,50,000, 1,80,000 something they have given. Creditors, bank overdrafts, something they have given. They have given some assets. They have given P&L debit balance and partners drawings information also. This is the information they have given. The operations of the business were carried till 31st March. Sir, this balance sheet is given on 31st December. Okay. Operation is carried till 31st March. You and we both withdrew in equal amount half the amount of profit made during the current period of 3 months. Sir, in this 3 months, whatever profit was there, out of that profit, now you could observe, withdrew in equal amount half the amount of profit. Out of total profit, half was withdrawn. That to that half, how it was withdrawn? Equally among the partners. Suppose profit is 20,000, then 10,000 will be withdrawn. How, sir? 5,000 and 5,000 each. Okay. After charging depreciation of 5,000 on plant and after writing off 5% of the building, during the current period of 3 months, creditors reduced by 50,000 and bank overdraft by, that means bank overdraft was reduced by another 50, stock was valued at 24, debtors at 40,500, the other items remained the same at 31st December 2021. Sir, are you all understanding, sir? Now what we should do? We have to prepare first of all a new balance sheet on this date. Only if we prepare a new balance sheet, then further discussion of this question could be done. Are you getting the point, sir? They have given a balance sheet. Now they are telling there were some changes in the value of assets. Now if you incorporate that changes, you will get the new balance sheet. Shall we find the new balance sheet, sir? Yes. Now, can you please tell me what are the opening capital balances effectively? Now, in the question something they have given, I just want to know effective opening balances, sir. Everybody, just right? Okay. Effective opening balances we are having here. What are the opening balances we are having? If you observe, 3 partners were there. Who are the 3 partners, sir? Two partners were there, U and V. Now, U and V, the balance given in the question, how much, sir? 1,50,000 and 1,80,000. But I think this I cannot call as real opening balance, because usually in capital account only profits will be adjusted and similarly drawings also adjusted. Am I right or not? But here they have given P&L balance separately and drawing separately. So first let us make it proper and find the new, that means proper capital balances at the beginning of the year itself. Tell me 60,000 loss, how it will be divided, sir? Equally, because profit sharing ratio equal. So thereby can I write like this? 60,000 means 30,000 to be reduced from each of the balances. Yes, sir. Next, drawings were there, you have to reduce this drawings also, 8,000 and 9,000. Now I will say these are the real opening capital balances. What is that, sir? This will be 1,12,000. This will be 1,51,000. Sorry, 41,000. So this will be the proper opening balances. Sir, accepted? Okay. Now, sir, they are telling that some changes was there in the new balance sheet. So what are the changes and what are the new capital balances we have to find. Now if we try to prepare a new balance sheet, just can you find what are the new assets, sir? Now what are the new balances? Plant, initially it is 1,85,000. Now they are telling in these 3 months you have to provide a depreciation of 5,000. So what will be the new plant value, sir? New plant value will be 1,80,000. Accepted. Next, and after writing off 5% on building, 5% means what, sir? Building will become 95,000. I am just trying to write the new balances, sir. Okay. Next, what is given? During the current period of 3 months, creditors reduced by 50,000, bank overdraft also reduced by 50. So reduce 50 from both, sir. So as a result, creditors will become 40,000 and bank OD will become 83 minus 33. Bank OD will become 83 minus 50, 33,000. Sir, are you getting the point? Plant is 1,80,000, building is 95. Now here it is, you are having 40 and 33. Not over, sir. They are telling stock is to be valued at 24,000. New balances they are giving. Stock 24,000, debtors 40,500. Similarly, That's all. Other items remained the same as at 31st December. We have recorded plant, we have recorded building, we have recorded debtors, we have recorded stock, all these values recorded. Now they are telling other items remained the same. Now tell me one thing, sir, how this change in net assets will come, sir? The change in net assets means it happens due to the profits only. Am I right or not? If I observe net assets on one date and if I observe the net assets on other date, what might be the reason for a difference, sir? Profits only. Let me show you. Now here, these are the closing net assets accepted. What are the closing net assets? After this adjustments, the new values 24, 40,500, 95 and 1,80,000, 3,39,500. Sir, clear? From this we will reduce the liabilities. We will get closing net assets as 2,66,500. Sir, discussion clear? This is closing net assets. What is opening net assets, sir, or opening capital? Can we say this is the opening net assets, sir? Nothing but these 4 values, from that reduce these 2. In other words, if we add these 2 also, we will get the same. That is 2,53,000 accepted. In this way also we can find, because capital balances together also will give you what, sir? Net assets only. So these 4 minus these 2 will give you also the same. How much it is, sir? 2,53,000. This gives you the change in net assets. Change in net assets happens due to profit only. So this is what the profit. Of course, this is net of drawing, sir. Are you getting the point, sir? This is the profit, what, sir? After adjustment of drawings. This indicates the profit which is retained in the business. Hello, are you getting the point? Why I am telling like that is, now in this closing balance sheet, I will get which capital here, sir? I will get the capital in which the profit is added and in the drawings is reduced. That means in this net assets also, which profit will be there? After reducing drawings only. Accepted. In this capital, how I get the new capital balances, sir? Opening capital plus profit minus drawings. This is what the new capital balance. Now what I say is, that means here also, how the net assets will change? Because of profit only, net of drawings. Net of, that means reduced by drawings. Profit less drawings, that will be the addition to the assets, that will be the addition to the capital. So I can say change in net assets gives you the profit net of drawings. How much, sir? 13,500. This is half amount, no? Because what is the drawing amount? Half. So thereby balance profit also half. So this makes total profit as 27,500 and combined drawings as 13,500. Hope everybody have understood how do we compute the profit which was net of drawings and the drawings amount. Once we know this, we can start filling the other, of course we can start filling the balance sheet, sir. Now look at the capital account, sir. First we will write opening balance 1,50,80. Anyway I have said you profits has to be adjusted 30 and 30. Drawings also to be adjusted. Now we will record the profit which was earned. How much profit earned? 13,500 and 13,500. Half amount was withdrawn. So 6,750 and 6,750. So this will be the closing capitals on 31st March. So this is what we will record in the new balance sheet, sir. These two will become the new capital balances. Rest of the values are same which we have recorded. That's all. Only these two we have to find, sir. When we write a balance sheet like this, I can find the balancing figure, sir. But I want to know individually what is U and what is V. For that, capital accounts only has to be prepared. For that, we should know the profit. That's why first I have found the profit and the drawings made. As a result, I am able to find the closing balance sheet. So hope everybody have understood how we have got this balance sheet on 31st March. Okay. Once we got this balance sheet, then the rest of the process is simple. Let me read what is the balance scenario. On 31st March 2022, the firm sold its business to UV Limited. The value of goodwill was estimated at 1,84,000 and the remaining assets were valued on the basis of the balance sheet as on 31st March 2022, except building and stock, which were valued as below building 1,20,000, stock 36,000. UV Limited pays the purchase consideration equity shares of 10 each. Sir, very simple. What they are telling is the business was sold at what value they have taken purchase consideration. They have not given directly, but they have said one point that goodwill was 1,84,000. How do you get goodwill, sir? Purchase consideration minus net assets. Hello, purchase consideration minus net assets gives you what, sir? Goodwill. Now here, once we know the balance sheet existing on that day, I think we can find the value of the net assets taken over. Now for that, if we add goodwill, now I think we will get the purchase consideration. They have not given directly the purchase consideration, because we know purchase consideration minus net assets gives us goodwill. Now we can find purchase consideration by adding goodwill to the net assets. For that, first we should find the value of the net assets acquired. It is not exactly book values. These two are changed. Balance is what, sir? The values on 31st December only. Now I will show you that new balances, sir. Ascertainment of purchase consideration. Now stock and building alone will change. Stock 36, building 1,20,000. That we will write. These two balances, the same balances which you have written in the balance sheet. What is that? Plant as well as debtors. 1,80,000 and 40,500. These two will be the same. These two are as per the new values. Liabilities also we will write the existing only. In that way, we will get the net assets which were taken over. For that, if you add goodwill, you will get the purchase consideration. How it is settled, sir? By issuing equity shares of rupees 10 each. Purchase consideration was settled, that is paid, by issuing equity shares of rupees 10 each. So, hope everybody have understood how the purchase consideration was derived. Once you know the purchase consideration, that means the number of shares issued, the rest is simple. They are asking us, what they are asking in the question, sir, please observe. You are required to prepare balance sheet of the firm, prepared, sir. Next, realization account and partners capital accounts. Now, realization means what, sir? Because the firm is being sold to company. Now, they are talking about realization, sir. What you will do? On which date they are selling, sir? On which date this is happening? 31st March. So, first in realization account, we will write all the values of assets and liabilities at this new book values. So, we will write down all the 4 assets, all the 4 liabilities. As we have found purchase consideration, we will write by purchasing company that purchase consideration value. Then the balance amounts will be transferred to capital accounts. Nothing but realization profit or loss will be transferred to capital accounts. Once we prepare capital accounts, already we know the opening balance on 31st March. For that, we will add realization profit also. Then we will these are to be settled by giving shares. In that way, shares will be given. So, hope everybody have understood how we prepare the balance sheet. Similarly, realization account as well as partners capital account. So, hope it is clear. Now, next, let me proceed to the next question, sir. With this, question number 2 was completed. Let me move to question number 3. Accounting for ESOP, employee stock option plan. Define the following terms. First one, vesting. Second one, grant date. Third one, exercise price. Hello, different terms are used, sir. We have to observe. What is the first one? Vesting. Sir, vesting means being entitled, sir. If the shares are vested, that means now a particular employee is entitled for those shares. It is entitlement, sir. Being entitled is called as vesting. So that's why we simply say vesting means to become an entitlement. Under ESOP, a counterparty's right to receive any shares, cash or any other equity vests when they have settled when they have satisfied the conditions, when it is no longer conditional. That means if the conditions are satisfied, they will be entitled to some shares or cash or anything, etc. Sir, why they have said cash or others? In CA Inter you are having ESOP, but later on you will get, sir, you are having other schemes also, stock appreciation rights, which we call as SAR. Similarly, ESPP, employee stock purchase plan, like the different schemes were there, which you will get in CA final, where employees may not be given just shares, they might be given cash also. So that is why they have given that. Okay, right. So hope it is clear. Next, grant date, the date on which this was announced. That is the date at which they have agreed, and when the company has made a announcement, sir, that is nothing but the grant date is the date when the approval is obtained. So hope everybody have understood. Just read it once, sir. You can write in technical terms. Next, exercise price. It is the price at which the share can be purchased, option can be exercised. It is the price payable by the counterparty for exercising the option granted to him in pursuance of the ESOP. So hope everybody have understood exercise price. So hope it is clear. Right. Next, one more point was there, part B. Noor Limited has its share capital divided into equity shares of 10 each. Okay. On 1/1/2021, nothing but the 1st January, it granted how many options, sir? 4,000 employee stock options at rupees 40 each. Okay. When the market price was 60, okay, the fair value of the option is 20. How do you get the fair value of the option, sir? Nothing but this is option value, sir, not fair value of the share. This is option value. What is option value, sir? Market price minus exercise price is called option value. Hello? Market price minus exercise price is called option value. Market price is 60, exercise price is 40, so option value is 20. So hope it is clear. The options were to be exercised between 15th March and 31st March. Employees exercised option for 2,500 shares only. Though the options was given for 4,000, they have given 2,500. Remaining were lapsed. Company closes its books of accounts. You are required to give the necessary journal entries. Okay. First, can you please tell me what is the basic journal entries that we pass, sir? Whenever we record the expense, usually we write employee compensation expense account debtor to ESOP outstanding. Am I right or not? Then we will charge this employee compensation expense to P&L to employee compensation expense. Then at the once the vesting period is completed, at the time of exercise, we will write bank account debtor, ESOP account debtor, outstanding account debtor, to equity share capital, to securities premium. This is the journal entry. Am I right or not? This over the period of vesting we will write every year, over the period of vesting, and this we will write at the time of exercise. Now what I say is, this is well and good if the vesting period is one period and if the exercise period is another. If first vesting period is completed, then if you have exercise period, like that, sir. But here if you observe, now that is not the point, sir. Here vesting plus exercise, everything is within the same year. Hello, what is that? Vesting as well as exercise, both are happening within the same year. You could observe everything is within 31st March 2021. When everything happens within 31st March 2021, there is no necessity of first of all creating this account. When you give shares immediately, you can directly credit to equity share capital, sir. Only when you have a delay, then temporarily we will use ESOP. At the time of exercise, we will debit it. But when vesting and exercise, everything is within the same year, this much not required. Simply what will be the entries, sir? We will write a combined entry for these two. We will not use any ESOP. What is the entry in such a case, sir? Entry will be directly, instead of ESOP, here we will debit employee compensation expense. Because in 1 year only everything happened. This is the first entry. Anyway being expense, we will charge to P&L. These two entries will be passed. Hope it is clear. What are the two entries? Bank account debtor, employee compensation expense account debtor, to equity share capital, to securities premium. That is the first entry. Then P&L to employee compensation expense. Hope it is clear. One more thing. Now, how much amount we have to debit to employee compensation expense, sir? Nothing but the value of the option. What is the option value? Market price minus exercise price. Now, actually, option values are of two types, sir. One is intrinsic, the other one is fair value. Intrinsic means market price on the date of grant minus exercise price. That is what intrinsic value of the option. If I consider market price on the date of grant, that is called intrinsic value. What is fair value, sir? If I consider market price on the date of vesting, in other words, expected date of vesting, by the date of vesting, if I consider the expected market price, then that option value is called fair value. Here anyway, that is fair value of the option, intrinsic value of the option. In the question, directly they have given the fair value of the option only. So once again, you need not confuse, sir. Is that clear, everybody, sir? Usually, they will give properly whether it is intrinsic or fair, but usually we consider only fair value. Don't confuse, is this market value or option value? This is clearly option value. You have to book at 20 rupees only. Let me show you the entries which we pass, sir. For how many options we'll write the entry? Directly for 2500, because need not first write for 4000 and reversal of 1500, not required, sir. Hello, writing down 4000 and reversal of 1500 not required. So hope it is clear. Directly we'll record for 2500. Let me write down bank account debtor 2500 into 40, employee compensation expense account 2500 into 20, to equity share capital 25,000. In this way, we have to record the entry. Bank account debtor, employee compensation expense account debtor, to equity share capital, to securities premium. So that is what the entry. Hope everybody have understood. How many shares? 2500 into 40. This is the exercise price. Option value is 20. We will debit it. To equity share capital, face value is 10. To securities premium, balance 50. This we will charge to P&L. P&L to employee compensation expense. That is the understanding. Working notes. No entry is passed when they are granted. For granting, no entry, sir. Only when exercise, it has to be recorded. That's all. Hope everybody have understood. With this, question number 3 was completed. Now let me move to question number 4. Complicated Limited, an unlisted company, gives the following information as on 31st March 2021. Okay, what is the information? Some equity share capital was given, sir. Share options outstanding account was given. Revenue reserve was given. Securities premium, P&L, capital reserve, unpaid dividend, 12% debentures, advance from related parties, current maturities of long-term borrowings, application money due for refund. Okay, received for allotment but due for refund. That means allotment was not done, we have to refund it back. PPE value, current assets, like that they have given some information. What they want, sir? Company wants to buy back 25,000 equity shares of 10 each at 15 per share. Buyback is duly authorized by its articles and necessary resolution has been passed by the company for this. Please observe carefully. Buyback is duly authorized by articles, sir. Resolution also passed. Buyback of shares by the companies is also within the provisions of Companies Act. This is very, very important point, sir. Sir, sometimes in the question, they may not say this and they simply ask whether this buyback is within the provisions of Companies Act or not. If they ask whether the buyback is within the provisions of Companies Act or not, then you have to apply the 3 tests. Hello? If they ask in the question whether buyback is within the provisions of Companies Act or not, you have to apply the 3 tests, sir. But when they have given clearly that buyback is within the provisions of the Companies Act, then you need not do anything special. Simply pass the journal entries and prepare the balance sheet. The payment of buyback was made by the company out of sufficient bank balance available as a part of current assets. You are required to prepare necessary journal entries towards buyback of shares and prepare the balance sheet of the company after buyback of the shares. Simply what you should do, sir, you should pass the journal entries and you should prepare the balance sheet. Sir, for buyback, how many journal entries will pass, sir? 4 journal entries actually. What are the four? One is entry for purchase, the other one is entry for cancellation, then the premium adjustment, then the last one CRR. Like that, four entries required, sir. What is the purchase entry? Equity shares buyback to bank account. That is the purchase entry. What is cancellation? Equity share capital account debtor, premium on buyback account debtor to equity shares buyback. This is the entry for cancellation. Then whatever premium was there, we have to adjust it with the securities premium. If it is not sufficient, free reserves. So entry will be securities premium to premium on buyback. Usually ICAI passes a combined entry for these two, sir. Instead of recording premium and once again adjusting against securities premium, usually they directly debit securities premium itself in the second entry. The third one is CRR, sir. We will write an entry for transfer to CRR. Entry will be free reserves to CRR. In that way, another entry will be passed. Now let us see the journal entries, sir. In this question, how many shares are being bought back? 25,000. What is the price? 15. So what is the entry, sir? Equity shares buyback to bank, 25,000 into 15. That is the first entry. Then what is the second entry, sir? After buyback, we have to write the cancellation. Equity share capital account debtor, premium on buyback to equity shares buyback. Here they have written separate entries only, sir. Happy. Now what we will debit here, sir? Face value 10 rupees, 2,500 into 10. This is premium 5 rupees. Next, we have to adjust this with securities premium. Securities premium to premium on buyback adjusted. First check whether securities premium was there or not. What is the securities premium amount given in the question? 2,50,000. It can be happily used. We will write that. Next, amount has to be transferred to CRR. Now I think you are having sufficient reserves, sir. Revenue reserve, P&L. These are all free reserves, sir. Now, what is revenue reserve, sir? It is actually the old name, age-old name for general reserve, sir. So, thereby general reserve, is it a free reserve or not? Yes, that is also automatically a free reserve. Whereas this share option outstanding account used for employees, capital reserve, not a free reserve, these things cannot be used. These are the reserves which can be used. Anyway, for CRR, how much amount required, sir? Only 2,50,000. We will debit the revenue reserves. These are the four entries. Balance sheet also very simple, sir. Only four entries. The impact will be very, very less. First, we will write down the items under appropriate heads, sir. Only change will be, I can tell you, a reduction of bank balance of 3,75,000 and equity share capital will reduce by 2,50,000. Securities premium will reduce by 1,25,000 and then we will transfer some amount from revenue reserve to CRR. These are the impacts, sir, but otherwise same. I think you can easily observe it, sir. Just I will show you in the notes to accounts. Equity share capital existing how much? 1,35,000 shares of 10 each. Am I right? Now, because how many shares were bought back? 25,000 shares. How many will be left? 1,10,000 shares of 10 each, 11 lakh. This will be the share capital. Reserves and surplus. Capital reserve will be the same, sir. Capital redemption reserve which we have created, sir, 2,50,000. Securities premium 2,50,000. We have utilized 1,25,000. 1,25,000 will be left. Share options outstanding account will continue the same, sir. Revenue reserves after reducing the transfer will record. P&L we have not touched it at all. Same balance will continue. In that way you will find the reserves and surplus. Once you find reserves and surplus, rest of the things are just presentation, sir. Current maturities of long term borrowings, previously this used to be presented under other current liabilities. Now because of the amendment, this has to be shown under short term borrowings. Then unpaid dividend and application money refundable, both are to be shown under other current liabilities. Now the debentures, secured as well as unsecured loans will be shown under long term borrowings. So these are the points. Hope everybody can understand. A simple question, sir. If at all in this question they are asking tests, then it may be difficult, but here it is simple. I have shown you all the working notes for these liabilities, assets, PPE same value, current assets you will reduce the buyback amount from that, you will get the new current asset value. So hope it is clear to you all. Now, let me move to the next question, sir. With this, question number 4 is completed. Let me move to question number 5. Equity shares with differential rights. Explain the conditions for equity shares with differential rights under the company's share capital and debenture rules. Sir, if at all a company wants to issue equity shares with differential right, first they have to prove some points to the government. I can tell you, what do you mean by first of all equity shares with differential rights? Usually, what is the voting process in a company? One share, one vote. Now, suppose you are having 100 shares. Now, how many votes will be there, sir? 100 votes. But still, there is a mechanism where even after you have 100 shares, you will be given only one vote. This is what shares with differential voting rights. Are you getting the point? Because you are getting less voting rights, as a compensation, you will be paid higher dividend. Let us say 5% extra. Are you getting the point, sir? You will be given, because of your shares, you will be given voting rights less, sir, but dividend rights will be higher. This will be taken up by small shareholders who don't participate in decision making. For their purpose only, this concept was introduced, equity shares with differential rights. Because there are many shareholders who don't want to participate in decision making and they simply want more and more return. For them, promoters thought that let them not come and disturb our decision making. Hence, what they have done, they thought to give voting rights less, whereas dividend rights higher. If you issue shares like that, such shares are called equity shares with differential right. When you can do like that, sir? Only when you can prove to everybody that you are running well. Because you are telling small shareholders, you will not take proper decisions, so you take less voting rights. When you are telling like that, first of all, you should prove that you are running well. For that, some points are there. Let me show you. The intention of all these points is to show that we are a successful company and our decision making is proper. It's okay even if small shareholders doesn't participate. That is what the intention. First, some procedural points will be there. It should be authorized in AOA. It should be passed with an ordinary resolution in the general meeting. Like that, some points will be there, sir. Next, you could observe the voting power in respect of shares with differential right shall not exceed 74% of the total voting power. Usually, they will be given less voting rights, sir. But as a clarity, they are giving. The company has not defaulted in. This was what the proving that company is a good company. They have not defaulted in filing financial statements and annual return. They have got no default in payment of any dividend or repayment of deposits or any redemption. Similarly, they have not defaulted in payment of dividend on preference shares or any repayment of loan, etc. Similarly, the company has not been penalized by court for any offense. That we are proving that company is a good company. If all these things are satisfied, definitely they can come and issue the equity shares with differential rights. So hope it is clear. One more point will be there, sir. 3 financial years immediately they should know. Okay, all these points are covered, right? That's all, sir. With this, I am closing this question. Just have one reading, you will get the point. Theoretical question. Next step. LMN and O hold equity share capital in the proportion of 30:30:20:20. In Hill Limited, X, Y, Z and K hold preference share capital in the ratio of 40:30:20:10. You are required to identify the voting rights of shareholders in case of resolution of winding up of the company if the paid up capital of the company is 60 and preference is 30. Sir, one clarity. When they are giving preference separately, don't think that in the 60 only 30 is there. This they are talking with respect to equity. This paid up capital means equity, sir. Whereas preference is 30. Now, out of 90 lakhs, now you could observe LMN and O, they are having in this way voting rights. X, Y and Z here in this way. They are asking individual voting rights. Tell me total how much, sir? 90 lakhs. In that, what is the voting rights of equity alone? 60, no? Sir, how voting rights will be decided? Based on the capital contributed only. So, equity shareholders have contributed 60, preference is 30. So, equity shareholders will have 2/3 voting rights, preference will have 1/3. That 2/3 will be divided in this ratio, 1/3 will be divided in this ratio. Have you understood, sir? Let me show you. First, equity and preference are having 2/3 and 1/3, because out of 90, 60 is by equity, 30 is by preference. So, 2/3 and 1/3. This 2/3 will be divided in the ratio given in the question. This 1/3 also will be divided in the ratio given in the question. So, hope everybody have understood. In this way, we will find the voting rights. A very simple question. What will be the voting rights if everybody attend for a meeting? It is simply based on the capital contributed. Okay, right. So, let me proceed to the next question, sir. Question number 6. This is amalgamation, sir. This is a question based on amalgamation. Let me read it. The following are the balance sheets of Akash Limited and Ganga Limited as at 31st March. They have given some information, sir. Okay. After the balance sheet, what they have given, sir? Let me read it. Both the companies go into liquidation and a new company, Akash Ganga Limited, is formed to take over the business. The following information is given. Sir, they want to take over both the companies, Akash Limited and Ganga, with in the form of a new company called Akash Ganga Limited. How they are taking, at what value they are taking, everything, let us read the information and let us record it. Ultimately, what they are asking, sir, you are required to prepare the opening balance sheet of Akash Ganga. Okay, right. Now, let us start reading the points one by one, then we will try to understand. Let me read it, sir. We are talking about a amalgamation where a new company is taking over two existing company. This is A, Akash, this is G, Ganga. The new company formed is AG, Akash, Ganga. Okay, right. Let me read the points one by one. All current assets of two companies except pledged inventory are to be taken by Akash Ganga. First, let me see the current assets information, sir. Now, this is current assets. You are having inventories, you are having other current assets. Now, what they are telling, all current assets will be taken except inventories, because you could observe this 368 lakhs, they are telling in secured loans that they are secured against pledge of inventories. When you have taken that loan, you might have given that inventories as a pledge. So, thereby you might have given it as a security. Now, what they are telling, except this, they will take the balance. In other words, they are ready to take current assets 72 and the 192 of Akash as well as Ganga. Now, at what values will be taken, sir? They are telling now, the realizable value of all current assets, including pledged inventory, is 80%. Anyway, will we take that pledged inventories? No. But in the case of Akash, the realizable value is 80%. In the case of Ganga, the realizable value is 70%. That means when we take over, here we will apply 80%, here we will apply 70%. Let me show you, sir, in the working note at what values we are going to take. Now, current assets, 80% we have taken in this 72 lakhs. Similarly, here out of 192 lakhs, we have taken 70%. Hope the assets taken over in that current assets is very clear. Okay. Next, what is given? This is with respect to current assets, sir. Next, property, plant and equipment of both the companies are to be taken at book value. So, I will observe the PPE of both the companies, sir. Simply, you will take at the book value. I will write the book values. Can I say this is the value of the assets taken? Happily. This is the value of assets taken over by the Ganga. But assets alone not sufficient, sir. We have to look at the liabilities taken over also. Let me read the next information. Secured loans include 32 lakhs accrued interest in case of Ganga Limited. Okay. Now, they are telling in secured loans 32 lakhs accrued interest is there in Ganga. Now secured loans 320 lakhs for Akash, 160 lakhs for Ganga. Now, what they are telling, out of this when I say secured loans, now you have to consider that interest also. What is the interest, sir? 32 lakhs. Okay, later on when we take over that liabilities, we'll talk about it. Next, 4 lakh equity shares of 10 each are allotted by Akash Ganga at par against cash payment of entire face value to the shareholders of Akash Limited and Ganga in the ratio of shares held by them in Akash and Ganga. Now what they are telling is, in the ratio of existing shares, the 4 lakh shares will be allotted. 4 lakh shares of 10 each will be allotted, sir, based on the existing shares they are having. While we will discuss at the end, sir, how the shares will be distributed. Next, preference shares in Akash. I think only you are having preference share capital in Akash Limited, sir. In Ganga Limited, you are not having any preference share capital. Okay, preference shares, share capital, how it is discharged, sir? What we are going to do? Preference shareholders in Akash Limited are issued equity shares in Ganga Limited worth 4 lakhs in lieu of their present holdings. That means in lieu of their present holdings, they are given only equity shares, that too worth 4 lakhs. Okay. Secured loan agreed to continue the balance amount on loans to Akash Ganga. That means what they are telling, sir, whatever secured loans are there now, that will be taken over by Akash Ganga. Okay. How, sir? After adjusting realizable value of pledged asset in case of Akash and after waiving 50% of interest in case of Ganga. Now, can I say like this, sir? This is the value of liabilities. You could observe secured loan. Just I am talking about secured loan. Look into the question. 320 lakhs and 160 lakhs is the loan amount. Out of that, now for Akash Ganga, what happens, sir? They are telling just you adjust. They are not talking anything about interest. They are simply asking you to reduce realizable value of pledged asset from this 320. We have to reduce 80% because already said inventories will be sold at 80%. If I reduce 80%, this is the value which will be continued in Akash Ganga. That means this is the value taken over by Akash Ganga. And similarly, with respect to Ganga Limited, once existing 160 will anyway be taken. Not just that, they are asking you to consider interest of 32 also. But they are telling in this interest 50% to be waived. That means how much will be taken over? Existing, sorry. You could observe out of 160, let me tell you one thing. Sir, they are telling secured loans include, sir. That means out of 160, 32 was already there. That means this is a combination of 128 plus 32. Now, out of 32, what they are telling, you please waive 50%, consider balance 50. That means we have to consider only 16 lakhs. So, thereby 128 plus 16, 144 lakhs. Here they are showing it as a reduction, sir, the interest which is waived. Hope everybody have understood. Sir, they are telling secured loans include. That means in that 160 lakhs only, 32 lakhs was already there. So, out of 32, they are telling waive of 50%. So, balance 16 lakhs will be continued. So, how much is waived we will reduce. This is the new value of secured loans which will continue. Sir, this discussion is about what, sir? Secured loans. They are talking about unsecured loans also. Unsecured loans are taken over at 25%. Employees are issued fully paid equity shares in respect of their dues. Now, first of all, how this is settlement. First, they should take over. No, statutory liabilities are taken over by Akash Ganga at full value. Now, what we will do, because they are telling employees are issued full, first we will take over and then settle. Statutory liabilities also full value. Both of them are to be taken at full value. Whereas unsecured loans at 25, trade payables at 80%. Let me write down, sir, all those things. First, look at the balance sheet, sir. What are the liabilities you are having in the question? First, secured loans. I have already said you how much to be taken over in the case of secured loans. These are the values. Unsecured loans, simply they are telling 25%. So, 25% you take in unsecured loans, sir. That will be the value of loans taken. Next, trade payables, they are telling 70%. So, simply, 80%. Simply, this 56 lakhs into 80% here, 36 lakhs into another 80%. In this way, you will get the value of trade payables taken over. Then, In other current liabilities, you are having two, sir. One is statutory liabilities, employees. Statutory liabilities, they are telling take at full value. We will take employees, they are settled by issuing shares. When we can settle, only first we take over. So there first we will take over full value. In this way, these are all the values of liabilities taken over. So hope everybody have understood. Sir, once we understood this value of assets taken over and value of liabilities taken over, the rest becomes very simple. Hope everybody have understood. So in this way, we will take over the liabilities. So hope you have understood how we have taken secured, then unsecured, then other liabilities. This is the total value of the liabilities taken over. So once we know the assets taken over, we have already computed here. You could observe, sir. Once we compute the liabilities taken over, now itself we have computed, and then you could observe to record anything in the books of accounts, we should find goodwill or capital reserve, sir. Now for Akash Limited, we are issuing preference shares also, because goodwill or capital reserve is for equity shareholders. We will add whatever settled to preference also. Another amount we have to settle what, sir? Preference, another 4 lakhs. That also I am adding on a net basis. You are having goodwill of 195 lakh 80,000 in the case of Akash. This is capital reserve in the case of Ganga. On a net basis, you are having net goodwill of 154 lakh 20,000. Hope everybody have understood. Once you know goodwill, balance values, now we will record in the balance sheet at the same, sir. Goodwill is important. Now we know the values of liabilities taken over. Now all these liabilities we will record in both, in Akash Ganga, or together by adding both. All the assets also will take together by incorporating. Then the difference we will write as goodwill or capital reserve. The net amount is goodwill. Now how do you issue the shares, sir? For these assets, some share capital should be there, no? So you could observe 4 lakh shares of, now you could observe the share capital, sir. First please observe the share capital. Now what is the share capital? You are having equity share capital 60 lakhs here, 20 lakhs here, total 80 lakhs. But we have already said how many shares will be issued. It is 4 lakh shares of 10 each. So for equity shareholders, 4 lakh shares of 10 each. Then for employees already decided we should give this many shares. For preference shareholders 4,000. So thereby this is the total number of shares, sir. This is the amount to be settled, 40 lakhs. This is the amount to be settled for employees as well as preference. Totally this much amount to be settled by way of equity shares. So divided by 10 gives you the number of shares to be issued, 14 lakhs. In that way, we will find the share capital. If I discuss about notes to accounts, mainly share capital is to be found. Then the other thing, simply at the new taken over values only we will record, sir. Nothing more. Whatever taken over values are there, at that values we will start recording everything. Automatically the balance sheet will get tallied. Main thing is goodwill and share capital, that we have discussed in the notes to accounts. Now other things are simply we will consider the values of assets taken over and values of liabilities taken over. In that way we will fill the balance sheet. So hope everybody have understood, right? Now with this question number 6 also completed, let me move to question number 7. Okay. Z Limited provides the following information as on 31st March 2021. Okay. What is the information? They have given share capital, P&L debit balance. Okay. This is a reconstruction question, sir. You are having P&L debit balance, you have to reconstruct the balance sheet. Okay. They have given some information. Now let us see various issues given, sir, and let us pass journal entries for each of the items, because usually in internal reconstruction main aspect is journal entries only, sir. What they are asking here, you are required to pass journal entries for all the above mentioned transactions, including the amounts to be written off for goodwill, patent and P&L. Also prepare bank account as well as reconstruction. Once we pass journal entries, automatically the ledger accounts also can be prepared accordingly. First, let us see the transactions one by one and pass the journal entries. First, they are telling preference dividend is in arrears for 2 years. Okay, tell me, preference dividend first of all, is it existing in the balance sheet as a liability? Yeah. Any preference dividend arrears, is it existing in the balance sheet as a liability? No. If it is not a liability, even if it is waived, then no entry. If it is liability and waived, it will get transferred to reconstruction. So now no entry. Next, Mr. Y holds 60% of the debentures and Mr. Z hold 40% of the debentures, and moreover 1,60,000 was also payable to Mr. Y and Z. Something they are telling, sir. Now relating to Y and Z, they have given one point. Let us see that, and first think of the entries related to Y and Z. Once we know this point, balance are very, very simple only. First, look at Y and Z, sir. First they are telling, first let me show you the values, sir. Y, Z. So what are the first they are telling they are having some debentures. Now what is the value of debentures they are having, sir? Look into the question, sir. Debentures amount. So it is 16 lakhs. Now out of the 16 lakhs, how much they have held, sir? 60% is by Y, 40% is by X. 16 lakhs into 60%, that means 9,60,000 is by Y, then similarly 6,40,000 is by Z. Now they are telling one point. Moreover, 1,60,000 were payable as trade payable. That means some trade payables also to be paid to both of them, Y as well as Z. How much, sir? It is 1,60,000 for Y and Z. 1 lakh is to be paid 60. Okay. Then what they are telling, sir? Mr. Y and Z agreed to cancel 50% of their total debt, including the interest on debentures. Okay, that means interest on debentures also not paid. Now look into the balance sheet. Is there any interest on debentures given in the question? Yes. 1,60,000. That means how much, sir? 10%. Let us divide, sir. That means interest on debentures. 10% means for Y 96,000, for Z 64,000. These are the total amounts payable to Y and Z. Clear? One is debentures and its interest. The other one is trade payables amount. Okay. Now what they are telling, sir? Out of this much amount due, they are agreeing to cancel 50% of the debt. Okay. What is 50% of this, sir? Just let me see. 9,60,000. Total is 9,60,000 plus 1,96,000. Total is 11,56,000, sir. Now they are ready to waive 50% of this debt. Are you getting the point, sir? So 50% reduction will happen. Okay. Not just that. For the balance, they are settling in new debentures. They want to give new debentures. But in the course, what they have done, they have also agreed to pay some cash also, maybe for useful for reconstruction. They are bringing some cash. When they are giving cash, now for this also we have to allot debentures. No. So thereby we will observe the sacrifice. Sacrifice will be transferred to reconstruction account. Then the balance amount due as well as this new balance. For that we have to allot the shares, new 12% debentures. Let me show you the journal entries, sir. First, these relating to Y. We will debit all these amounts. Am I right or not? Then we will write bank account. Now how much we will write to reconstruction? What is the due amount, sir? Total 11,56,000. In that make it half, sir. So 5,78,000 will be the amount transferred to reconstruction. So how much to be settled? 5,78,000. For that, they have brought one more 1 lakh for your purpose, for company's purpose, plus 1 lakh, total 6,78,000 to be settled. That we are settling by issuing 12% debentures. Hope everybody have understood. That is one important point. Z also in the same way. First we will write all the amounts. Together it is how much, sir? 7,64,000. In that half transferred to reconstruction. For the balance along with the new amount brought, for that we will give the new debentures. Hope everybody have. These are the main points, sir. If you have understood this, balance we can complete quickly. All equity shares are to be converted into 5 each. At present how much, sir? 10 each. We have to convert into 5 each. What is the entry, sir? Equity share capital to equity share capital. Will debit 10, will credit 5, balance 5 will transfer to reconstruction. Simple entry. Next, what is the second point, sir? Preference shares are to be reduced to 50 each, and the preference shareholders agreed to forgo their arrears. If they waive it, tell me, will we record anything? No, not required. In consideration of which 9% preference shares are to be converted into 10. 100 is to be reduced to 50 and they are foregoing the dividend. For foregoing dividend, we will not pass any entry, but for reduction, they are telling we have to pass the entry. Similarly, 9% to be converted to 10%. What is the entry? 100 we will reduce to 50, but in the course we have to change the percentage from 9 to 10, balance amount transferred to reconstruction. That is the entry for preference. For third point we have seen, the next persons relating to trade payables other than Y and Z also agreed to forgo 50% of the claim. Now you could observe total trade payables how much? 5 lakh. In that, how much is held by Y and Z? 1 lakh plus 60, 1 lakh 60. What is the balance, sir? 3 lakh 40. In that 3 lakh 40, 50% is being waived. So what is the entry, sir? Trade payables to reconstruction. So 1 lakh 70. They have not said balance 50% is settled. That's why we have not written anything. Simply 50% sacrificed, hence transferred to reconstruction. So this is 3 lakh 40. How do you get 3 lakh 40? 5 lakh minus 1 lakh 60 into 50%. Next, they are telling one more point. Directors also waived 60% of their loans, and for the 40% they have accepted equity shares. Look at the directors loan given, sir, in the question. So in the question, loan from directors 1 lakh, 60% sacrifice transferred to reconstruction. For the 40% we will allot the shares. Already we have converted shares into 5 rupees, no? So we will issue also shares of 5 rupees each only. Directors loan, to sacrifice transferred to reconstruction, to equity share capital. Next, what is the transaction, sir? This is completed. Capital commitments of 3 lakhs were cancelled on payment of 15,000 as penalty. Sir, usually whenever we are a company, we enter into various transactions, sir. We enter into commitments because suddenly we thought to reconstruct, do some adjustments for our company. We thought not to continue that contract. Why it happened, sir? Because you have taken this decision. Suddenly cancelling a contract means other party will say you have to pay me penalty. You are cancelling contract suddenly. So whatever penalty you are paying because of this reconstruction or not? Yes. So thereby simply you will write reconstruction account at R2 bank for that penalty. Next, directors refunded 1 lakh of the fee previously received by them. Already they have received, now they are refunding. Anyway, nothing mentioned in the balance sheet or recorded for this. Already recording was done, sir. Now simply it's an extra income to us. Why it is happening? Because of reconstruction. We will write the entry bank account at R2 reconstruction. Next, reconstruction expenses paid 15, reconstruction to bank 15,000, normal entry. Then taxation liability was settled for 75 and paid immediately. What is the tax liability given in the question, sir? 1 lakh, settled at 75. So to bank 75, balance will be transferred to reconstruction. Next, they are telling few more points, sir. Just wait. The assets were revalued as under. They are telling assets were revalued, sir. Now for this revaluation, if increase we will debit the asset, if decrease we will reduce it, sir. We will record correspondingly. We will look at the book value and we will pass the entries. Land and building alone increase was there. We will debit the land and building and credit the reconstruction. All other assets, they are telling they have given some reduction only, that we will write off here, sir. And they are telling goodwill, patents and P&L loss has to be debited. We will write down that one also. Goodwill, patent and P&L. All these are reductions as given in the question. The balance amount will be transferred to capital reserve. That is what the last entry. Now all these transactions, already we have passed the journal entries. Correspondingly, ledger account preparation is very simple once we know the journal entries. Hope everybody have understood this question. Just look after that bank account and reconstruction, sir. It will be simple because already we have completed the journal. The same will be posted. That's all. With this we have completed question number 7 also. Now let me move to question number 8 relating to liquidation of the company. The balance sheet of Cloud Limited as at 31st March 2021 being the date of voluntary winding up is as under. They have given one balance sheet, sir, here. They have given subdivision also clearly. Okay, what they are asking, sir? They are telling some information, sir. First of all, what they are asking in the question? Okay, they are asking us to prepare liquidator's final statement of account. What is liquidator's final statement of account, sir? In that we will show what are all the receipts we are having, what are all the payments we are having in a prescribed order. Now if you observe, they have given some assets realization, sir. What are the assets realized? Land and building, plant and machinery, inventory, trade receivables. Simply what we will do, sir, we will receive all those things, we will show all those amounts as received, we will get the amount realized. Now this we have to use for making various payments, of course in a prescribed order. Now they are telling liquidation expenses is 1,72,000. Before liquidation expenses, first what we will do, liquidators remuneration. Have they given any clarity? Yes. Remuneration of liquidator is 2%. So already we have found the value of the assets realized. Now we will apply 2% on it. It is 92,000. First liquidators remuneration. Next liquidation expenses we will write. Next actually for presentation purpose we will record secured, that means debentures. Next unsecured, but actually in unsecured preference will be given to few parties which we will call as preferential creditors. Hope you remember. So for presentation sake usually we present it second, but sometimes they will present here also. Here they have done the same. First they have given preferential creditors. Now they have given in the balance sheet itself, sir, preferential creditors 2,10,000, that anyway we will write. Income tax liability in addition given 1,34,000. So these two we will write, these are the liabilities to be settled. Next, interest on debentures for the year ending has not been considered in the given balance sheet. Now debentures also to be settled or not, sir, this 4,20,000 along with the interest we will show as the liability amount to be settled. Now similarly you are having some other liabilities also given in the question, sir. Bank OD is there, some trade payables is also given in the question, trade payables and short term this bank OD. Now that also you will show here, sir, bank OD 9,70,000, trade payables. Once you write all these unsecured, then some amount will be there. This will be utilized for members. First preference, relating to preference they have already given one point in the information, sir, please read it. Preference dividend is in arrears for 3 years. So that means preference capital has to be considered. How much, sir? 10 lakhs. In addition, we have to look at the arrears also. 10 lakhs into 10%, 1 lakh. Like that, how many years? 3 years. So totally 13 lakhs. Like this, the payments also should be recorded. First various receipts, sir. Next, we will consider all the payments. Now, anyway, when we are making payment, we have to check whether it is sufficient. If you observe till now, the amount will be sufficient, sir. Now, total payments before equity shareholders is 45,40,000. That means amount left for distribution to equity shareholders, how much, sir? 60,000. Now, how to distribute this 60 is also important. Then only we can complete what, sir? Liquidator's final statement of account. Now, if you observe, now all the equity shares are not of same denomination. Sorry, not of fully paid, sir. One is 60 paid, the other one is 50 paid. First we have to make both of them equal. How to make, sir? Make a notional call. Surplus till now you are having how much? 60,000. From that 10,000 shareholders, call the balance 10 rupees so that both will be equal. Now I will call 10 rupees. So the new amount available will be 1,60,000. Now how many shares we will consider? Once both are of 60, we can consider 20,000 shares are there. So divide by 20 per share, how much amount to be given back, sir? 8 rupees. But understand, for this 60, we will give 8 rupees, sir. For this 50, anyway we need to collect 10 and we have to repay 8. Collecting 10 and repaying 8 may not be required. Straight away we will collect the net amount 2 rupees. In that way we will pass the entry, sir. I will show you. This is collecting the money. How much, sir? 2 rupees on 10,000. So 20,000 will be collected. Now the brought amount will be paid to the balance persons. 10,000 we will pay 8 per share, refund 80,000. In this way you have to fill liquidator's final statement of account. Very simple, sir. We will write all receipts. We will write all payments. Payments has to be recorded in the order. And only thing is that when shares are of different paid up values, you should know, first you should make a notional call, then the amount has to be computed, which is to be distributed per share. In this way, liquidator's final statement of account is completed. So hope everybody have understood till now. We are there in question number 9. Okay, right. NBFCs. Now calculate owned fund of an NBFC based on the following information. I think in NBFC chapter, we will say clearly that if you want to register with RBI, you should have a minimum net owned fund, you should have a minimum net owned fund of 200 lakhs. Do you remember like that, sir? We will say that if you need to register under RBI, you should have a minimum net owned fund of 200 lakhs. Now there comes a question, first of all, what is owned fund? Now in fact, in this question, they are asking the same, compute the owned fund. Now what is owned fund in that point, sir? Now we will learn in this way, owned fund or own funds. It is paid up capital. Own funds means what, sir? Our own fund, shareholders funds, am I right or not? So paid up capital plus reserves and surplus. This is what in simple, but let me tell you some adjustments and quickly apply here. Sir, when I say paid up capital, can I consider both equity as well as preference? Equity can be considered, preference can be considered only if it is convertible. So if it is convertible, preference also can be considered, because own fund means how much of our own fund is available, that means shareholders fund is available to give as loans. If you are having more and more fund to finance people, then they will allow you to register as NBFC. So thereby preference, if it is convertible, that means money always lies with the company only, then we can consider, otherwise we cannot say it will continue for longer period. Hence preference will be part if it is convertible. When I come to reserves and surplus, what can be part of that, sir? General reserve and P&L are always okay. They are free reserves. If they are existing, that can be considered as a part of own fund. Securities premium, can it be part, sir? Yes, securities premium also can be part. Don't feel that securities premium can be used for 5 purposes. Here we are there in NBFC. For banking or NBFC, the 5 restrictions on securities premium doesn't apply. Anyway, we are not dealing with purpose. Once securities premium is there for you, amount is there. Now that amount also, will you keep it idle? If you have received any securities premium, you will not keep it idle. You will use it for business only. So thereby that will be used for giving loans. Happily it will be part of the net owned fund. Then capital reserve, if it is yes, if it is arising from sale of asset. In other words, if it is realized, it's okay, we can consider if it is arising from sale of asset. Then one more point we will have, sir, just like we are considering all these things, if there is any revaluation reserve, it should not be considered. So these things are usually considered, whereas revaluation reserve is not considered. We have to add in this way. But one more thing, sir, when you are considering paid up capital, when you are considering reserves and surplus, this is source. Now how it is applied in various forms, may it be in fixed asset, may it be in investments, may it be in current assets, etc. Now what they say is, if you are considering this element, that means indirectly you are considering this amount also. Am I right or not? So that means once again, you need not specifically consider these assets amount, because this is the source for it, this is the application. We have to look at only one angle. Now what I say is, now in the question they have mentioned intangible assets. Now you should know one thing, sir, if there is any intangible assets, now for that source will come from where, sir? If there is intangible asset, how you might have created that intangible asset? It might be from here only. What they say is, sir, intangible assets, goodwill or any other patents or something, whatever, generally it may not fetch you any value when you sell, because you will not sell the organization, no? So it cannot realize something. Suddenly, can you get some amount, that to definite amount? No. Usually, the amount of share capital or profits to the extent invested in any intangibles will not be considered. I think this you might have observed in your formula itself. So what we will reduce? Any intangible assets or any accumulated losses or any deferred expenditure, like that we will reduce, then we will get own fund. In this way own fund computation will happen. Hope you remember. Now let us look into the question. Compute the owned fund. So paid up capital will be part, yes. Compulsory convertible preference shares will be part, yes. Free reserves, yes. Revaluation reserve, no. Securities premium, yes. Book value of intangible assets, we have to reduce this. Now similarly, capital reserves, this is arising from sale of assets, yes. So thereby if they ask you the owned fund, paid up capital 200 lakhs, free reserves 150 lakhs, convertible preference shares 50 lakhs, 25 capital reserve, total 440 reduced by the 10 lakhs, 430 lakhs will become understood as own fund. So hope everybody have understood. Revaluation reserve to be excluded while computing the own fund. So hope the discussion is clear. Next. This is about computation of own fund. Hope everybody just remember those aspects, what are to be considered and what are not to be considered. Next. While closing its books of accounts for the year ended, an NBFC has its advances classified as follows. Standard assets, substandard assets, then doubtful, then secured portion of doubtful, D1, D2, D3, then unsecured portion and loss assets. Compute the amount of provision which must be made against the advances as per NBFC NSI ND, NSI. In other words, is this systematically important or non-systematically important? Non-systematically important. Let me tell you the percentages, sir. Sir, it is 0.25 if it is ND NSI. If it is NDSI, 0.40, which is similar to banking companies for standard. From substandard onwards, 10%, 20%, 30%, 50%, then 100 and 100. These are the percentages. Now, because we are ND NSI, 0.25 to be applied for standard, and for the rest, the following percentages are to be applied. So, once we apply these percentages for the corresponding amounts, we will get the provision to be created. So, hope you remember the provision percentages. That is all. Only just remembering provision percentages is the point. Right. Now, let me continue with this. Question number 9 was completed. So, let me move to question number 10. Banking companies. The following figures are available from the books of Star Bank Limited for the year ended 31st March 2021. Okay. Now, they have given some information, sir. Some incomes and expenses were given. We will consider. Now, following further information is given. First, what they are asking, you are required to prepare P&L account and the schedules of profit and loss of Star Bank for the year ended 31st March 21. That is also not sufficient. Also show how the profit and loss account will appear in the balance sheet. We also should show what, sir? How the profit and loss account will appear in the balance sheet. So, like that, 3 aspects they are asking. In other words, schedules, P&L format, and then closing P&L balance. This is what they are asking. First, let me show you the format of banking companies. Now, first, we will write incomes. How many incomes, sir? 2 incomes, interest earned and other income. Schedule 13 and 14. Sir, in banking companies, schedule numbers are fixed, whether you are having details or not. When it comes to expenses, first you will start with interest expended, schedule 15. Then you will go with operating expenses, schedule 16. Of course, you will have one more expense. What is that? Provisions and contingencies, which we have to compute. Once we get that, we will get total expenses. Then we will have profits or losses. In that net profit for the year, how do we get it? A minus B. In other words, total profits, total incomes minus total expenses will give you profits. Then you will have appropriations, if at all anything given in the question. This is the format, sir. Now, after the format, they are asking one more thing, that is format. Then they are asking notes to accounts. Now, first let us see each item and drop under the corresponding schedule. Then it will be simple. Let us start one by one, sir. First, interest and discount received. So where we will record, sir? Under interest earned. Both will record under interest earned. But let us look whether there is any adjustment for this. Now if you observe, they have given rebate on bills discounted, sir. I think you remember how do you compute discount to be transferred to P&L? We will have like this, sir. Opening rebate plus current year discount minus closing rebate gives you amount to be transferred to P&L. Hope you remember this. In this way only we will compute the amount to be, discount amount to be transferred to P&L whenever rebates question was given. Now here also we will apply the same. What is opening rebate, sir? 60,000. What is closing rebate, sir? 80,000. This is opening rebate 60. This is closing rebate 80. For that you will add current year interest and discounts, because anyway both will go to P&L only. So 152 lakhs 640. We will write 152 lakhs 640. Maybe then we will get the interest amount to be transferred to P&L. It is nothing but 151 lakh 80,000 640. So hope everybody have understood how we got this interest and discount earned. Next, this is schedule 13, sir, interest earned. Then what is the next one? Other income. Are you having any other income? If it is there in the flow, we will record. Now at present it is not there. Interest paid on deposits. Now interest paid which schedule, sir? Schedule 15. So we will record under schedule 15. Interest paid what, sir? 91 lakh 81,000 440. Salaries and allowances. Now this is operating expenses, sir. In operating expenses we will write 10 lakhs. Next, directors fees and allowances, once again under other operating expenses only. Rent and taxes paid, you will write under once again operating expenses. Postage, operating expenses, all these things you will record, sir. Rent and taxes. Similarly postage. Sir, order is not so important, it's up to you, just follow the order given in the question, it might be sufficient. The next, statutory reserve fund. Now this is opening balance of statutory reserve fund, sir. Can be used for preparation of balance sheet but not for P&L. Next, commission, exchange and brokerage earned. This is what, sir? Other income, schedule 14. In other income we will write this commission, exchange and brokerage, rent received, profit on sale of investments. The three items are to be recorded in where, sir? Schedule 14, other income. Then next, you are having depreciation on assets. Depreciation is recorded under which head? Operating expenses. So in operating expenses only we will record depreciation of 1,60,000. Then next, you are having statutory expenses, where we will record operating expenses, preliminary operating, auditor's fee operating, everything auditor's fee, statutory expenses and preliminary, all these things you will record under operating expenses. In this way all the items given we will divide into either of the schedules. Let us see the additional information. Issued and subscribed capital is 40 lakhs, useful for balance sheet purpose. Preliminary expenses to be fully written off. In fact, that is what we have done by charging to P&L, 1,20,000. Next, rebate we have considered. Transfer 25% of the profits to statutory reserve. This is done at the time of appropriation. Income tax of 8 lakhs to be provided. In other words, they are telling provision for income tax. I think you should remember, in banking companies we will be having a separate head. What is that, sir? In P&L, provisions and contingencies. Do you remember, sir? Under this only we will write all types of provisions including provision for tax. So thereby provision for tax 8 lakhs to be recorded there only. Next, Mr. G, a customer of the bank who had taken an advance of 40 lakhs from the bank, became insolvent and only 25% was expected to be recovered from his estate. How much was expected to be recovered? 25%. That means how much may not be recovered? 75%, for which what is required, sir? Provision. So thereby 40 lakhs into 75%, That means for 30 lakhs provision is required. Anyway, for income tax, how much is required, sir? 8 lakhs. So, hope it is clear. Then one more thing they have said, a provision of 8 lakhs was also necessary on other debts. Okay, if we create that one also, overall how much provision required, sir? 46 lakhs is the overall provision required. So, that also we will mention, sir. So, under the head provisions and contingencies. Now, with this you could observe in our format we will be able to fill first one interest earned, next other income also we can fill, interest expended we can fill, operating expenses we can fill, provisions for taxes. One from that if you reduce you will get net profit or loss for the year. Have they given any opening P&L balance, sir? No. So, thereby simply we will write this is the current year profits. Out of the current year profits they have said 25% to be transferred to statutory reserve. So, that we will record, balance will be carried forward to balance sheet. So, 8,01,780 will be the closing balance in the P&L. So, hope everybody have understood. So, that is what they have asked in the question, sir. 3 things they have asked. First one, preparing P&L completed, schedules also over. Then they are asking P&L closing balance. So, hope everybody have understood. Now, next question, consolidated financial statements. From the following information of Beta Limited and its subsidiary Gamma Limited drawn up at 31st March 2021, prepare a consolidated balance sheet as at that date. So, we should prepare a consolidated balance sheet. Okay, they have given some information, sir. Now, we have to prepare a consolidated balance sheet. First, we will write down what are the things required for us, sir. Then we will start looking at the balance sheet. Then it will be simple. Shall we start, sir? Yes. First, what is required? Minimum for us, some basic data is required, sir. What is that? Basic data or cut-off data. What is that, sir? We should know DOA, date of acquisition. We should know DOC, date of consolidation. Similarly, percentage of holding company or holding interest. Similarly, percentage of minority interest. This is something basic, sir. Then only we can proceed further. Please look into the question. Now, they are asking us to prepare consolidated balance sheet. When the acquisition was done, sir? Now, you could observe reserves and P&L account of Gamma Limited stood at 62 and 37,500 respectively on the date of its acquisition of 80% shares by Beta Limited on 1st April. When it happened, sir? 1st April 2020, and we are preparing consolidated balance sheet as on 31st March 2021. That means acquisition happened at the beginning of the year itself. Date of acquisition is 1st April 2020, whereas date of consolidation for us year ending is 31st March 2021. What is the percentage of holding interest, sir? Now, you could observe at the investments, shares in Gamma Limited, 2000 shares at rupees 200 each, 4 lakhs. Total, how many shares are there in Gamma Limited? You could observe it is 2500. So, 2000 divided by 2500 into 100 will give you 80%. Anyway, they have only said what is the percentage acquired by the first company? 80%. So, percentage of holding interest will be 80%. Percentage of minority interest will be 20%. Hope this basic data is clear. Once we know the basic data, then we could start thinking of the others, sir. First, we should be able to identify the profits classification. Hello, what is that? Classification of profits. Now, which profits, sir? Look at the head reserves and surplus. Under that, what are all the items we are having? We should classify. Now, look into the question. Under reserves, under the head reserves and surplus, we are having 2 items. One is reserves, maybe we can consider as general reserve. Then P&L, you are having 2 things, sir. So, these are the closing balances. Now, you are having opening balances also, 62,500 and 37,500. So, let me show you, sir. So one is reserves, of course, general reserve I can say. Then similarly the other one is P&L. What is opening, sir, you are having in reserves? Please look into the question. Reserves opening stood at 62,500. Opening is 62,500. Now what is closing given in the question, sir? Everybody, what is the closing reserves given in the question? It is 1,87,500. Hello? It is 1,87,500. Now look at the P&L also. Closing balance is 62,500, whereas what is the opening balance given in the question, sir? Opening balance given is 37,500. That is the P&L opening balance. Opening balance is 37,500. Now reserves and surplus increased by how much, sir? So you can say it is 1,87,500 minus 62,500. 62,000 is opening, 62,500 is opening, 1,25,000 is the current year transfer. So I can say 62,500 is the revenue profit, capital profit, whereas 1,25,000 is the revenue, because acquisition happened at the beginning of the year only. If it is in between the year, then we have to subdivide current year portion also. Here, because at the beginning entire 62,500 will become capital profits, entire 1,25,000 will become revenue profits. Then if we talk about P&L, opening balance is 37,500. Now closing is 62,500. What might be the current year, sir? I can tell you one thing, sir. Entire current year profit, if you ask me, I can say it is not just the difference of 25. I can say 25 plus 1,25,000, total current year profit is 1,50,000. Out of that, transfer to general reserve is 1,25,000. The difference is 25. This only gets added to the opening P&L and you will get the closing P&L. Are you getting the point? Because how general reserve will be created, sir? Out of opening P&L only, out of P&L only. So thereby, in that way we will show that means total current year profits might be 1,50,000, out of which we will reduce transfer to general reserve, we will get the current year addition. So I can say 37,500 is capital profit, 25,000 is revenue profit. In this way, we should analyze the profits given in the question. Let me show you in the solution also how it was given. Okay. So you could observe pre-acquisition profits. How much, sir? It is pre-acquisition or capital profit 62,500 plus 37,500. So that is what pre-acquisition profits we are having. Revenue profits, if you observe, so it is what at present, without considering this depreciation effect, it is 1,25,000 and 25. Let us see what is the depreciation effect. Machinery book value is 2,50,000. Okay, furniture book value is 50,000, were revalued at 3,75,000 and 37,500 on 1st April 2020 for the purpose of fixing the price of its shares. Now what we should do, sir? The opening book value is 2,50,000. This is machinery. Closing book value is 2,25,000. Hello, opening book value 2,50,000. Closing is 2,25,000. That means how much depreciation? 10%, 25,000. I think exactly matching. Now furniture also 50,000 is the opening book value. 15% is the rate of depreciation. That means 7,500. Closing is 42,500. In this way it was done. But actually how much should have been, sir? It should have been 3,75,000 opening and furniture also 37,500. Two things we should observe, sir, whenever there are fixed assets. One is profit or loss on revaluation. The other one is excess depreciation already provided or further depreciation to be provided. Like that we have to compute. First let me find the profit or loss. Now two assets are there, one is machinery, the other one is furniture. We have to observe book value, we have to observe revalued amount also. What is revalued amount given in the question, sir? 3,75,000 for machinery, 37,500 for furniture. What is book value for machinery? 2,50,000. Furniture is 50. I can say the profit or loss, gain or loss on revaluation is 1,25,000 for machinery and 12,500 loss for furniture. This is which nature, sir? This profit or loss is of capital nature, that is pre-acquisition. Total you can say 1,12,500. This is a pre-acquisition loss profit. Okay. Similarly, further depreciation or excess depreciation we should compute, sir. Actually depreciation provided on how much, sir? 2,50,000. But if depreciation was provided correctly on 3,75,000, that is depreciation actually required, we have to compare with depreciation already provided. If we compare like this, we will get further depreciation or excess depreciation. Machinery actually required how much, sir? 3,75,000 into 10%, which is 37,500. Already provided how much, sir? 25. That means further depreciation to be provided is 12,500. Whereas furniture already provided is 50,000 into 15%, 7,500. Whereas actually required is 37,500 into 15%, which is 5,625. Whereas already provided is 7,500, something extra was provided. How much, sir? 1,875. This is reverse. That means on a net basis, I can say it is 10,625 extra depreciation to be provided. Extra depreciation or further depreciation to be provided means profit or loss? Loss. Which nature, sir? Revenue nature. This is a revenue loss to be shown. So hope everybody have understood. Let me show you all these elements, sir. Now if you ask me, this is pre-acquisition given, then profit or loss on revaluation, you could observe it is 1,12,500. Now with respect to depreciation, I have shown you it is on a net basis. Now let me show you, sir, how the further analysis will happen. So this is what profit or loss in the case of revaluation, this is what further depreciation. Now how to divide, sir? I will show you. Now please observe carefully, everybody, very important. Now let us divide this into holding company as well as subsidiary, then we will have a good understanding. Now I will divide, sir, please observe carefully. Actually for consolidation, the format followed by ICAI is a bit different. If we follow in this way what I have given, it is simple for you to analyze, that's all. So particulars, holding company, first of all we will write total, holding company, then minority, like that we will divide. What is the percentage we are having? 80% and 20%. Now please observe carefully. What is the share capital subsidiary is having, sir? Everybody please observe. What is the share capital subsidiary is having, sir? Subsidiaries share capital as given in the question. Everybody have to observe. So it is 2,50,000. That 2,50,000 we have to divide into 80% and 20%, which is 2,50,000. Okay. Then we have to see pre-acquisition profits. What are the pre-acquisition profits we are having? I think we are having general reserve, we are having P&L, and we are having this profit or loss on revaluation also. I think we can subdivide. What is general reserve profit we are having, sir? Pre-acquisition 62,500. Similarly, P&L 37,500. This profit or loss on revaluation 1,12,500. So hope everybody is able to understand. Now this is pre-acquisition, sir. If you ask me post-acquisition, you are having general reserve 1,25,000, P&L 25,000, then further depreciation to be provided. Further depreciation to be provided, it is 10,625. This is a loss. This is a loss. Actually, this has to be reduced from what, sir? P&L only. Let me show you. If you ask me the P&L amount that has to be divided, from this we have to reduce that 10,625. How much will be the amount, sir? 25,000 minus 10,625. It is 14,375. This amount has to be divided, P&L. This is the general reserve amount to be divided. If you ask me the division, the total capital profits, 62,500 plus 37,500 plus 1,12,500, that is equal to 2,12,500 total. This has to be divided into 80% and 20%, which is 1,70,000 and 42,500. When it comes to post acquisition, here also we can divide, sir. 1,25,000 into 80%, 1 lakh, and here 25,000. Now this 14,375 also can be divided into 80%, 11,500, 20%, 2,875. Sir, why you are dividing like this? Now to find the minority interest and for various other aspects, sir. Now here, what is the minority interest, sir? Share capital 50,000. Now capital profits portion 42,500. Then post acquisition minority share. So we can add all these things, 42,500 plus 25,000 plus 2,875 plus that 50,000. In this way you will get the minority interest, 1,20,375. Let me show you, sir, the computation of various informations one by one here. First I will show you the minority interest, how much you will be getting. The total is 1,20,375, sir. I will show you how we have got, and I will show you the ICAI presentation also. Share capital minority share, pre-acquisition profits minority share, in post-acquisition also minority share. That is what they are writing, sir. Share capital the minority share. Similarly, pre-acquisition profits minority share. Just they have divided revaluation alone separately. Minority share total is 42,500. Then general reserves 25,000. P&L 2,000. In that way you will get what, sir? Minority interest. So hope everybody have understood. If we need to compute goodwill or capital reserve, how we will compute, sir, that cost of control? It is investment less share of net assets. What is investment, sir? Go and look into the question for the investment value. Investment value given in the question is how much, sir? 4 lakhs. 4 lakhs is the investment value. This is 4 lakhs. Now from this you will reduce the share of net assets. What is the holding company's share of net assets? 2 lakh plus share capital plus pre-acquisition profits. Nothing but 3,70,000 will be considered as what, sir? The share of net assets. As a result, you will be having a goodwill of 30,000. Now let me show you that part also. Goodwill of 30. How do you get? 2 lakhs is the share capital portion. Now 80,000 and 90,000 is that 1,70,000 which I have shown you here. 1,70,000. Then that this together gives you what's a 2 lakh plus 1,70,000. 3,70,000 is the total. You will compare with the investment. You will get the goodwill or capital reserve, which is how much, sir? 30,000. Hope everybody have understood. These two are main, sir. Minority interest as well as goodwill. The other things you can find easily. I have already given you. Now what is the post acquisition profits, how it will be divided? Okay, right. Now, okay. So this, sir, here whatever given in this working notes might be this division. They are dividing individually that pre-acquisition profits and profit on revaluation. I have done together. Similarly, post acquisition also they have done reserves alone separately and P&L separately. I have done both of them together. That is what it happened. So hope everybody have understood. Okay, right. Here we have got 14,375. No, ultimately here also that 14,375. That only they are dividing into 11,500 and 2,875. So I hope till now the discussion is clear. Once you are able to complete these main parts, now the rest of the balance sheet looks very, very simple. You have to be clear only with respect to this property, plant and equipment, sir, where you will record the machinery values. How do you record machinery? You will add profit on revaluation, reduce the further depreciation. In the case of furniture also, because it is loss on revaluation, you will reduce it, and because depreciation is to be reversed, you have to add it. Sir, there was some mistake, I think. Reversal was there. Now, first for that 37, okay, they are finding in a different way. Now, please observe, for 30, first we have to consider the adjustment 37,500. Then there is a reversal of depreciation. Okay. Now you could observe, first they are changing the opening only, and on opening they are providing corresponding depreciation. You can do like this, sir, or what you can do, for this 50,000 only, what we will do, sir, whatever loss was there, you will reduce it. The reversal also you can provide, in that way also you will get. Sir, one way is finding the proper balance, on that directly applying depreciation, 37,500 into, that 15% they are applying. Now here also, first they find the proper revalued amount, on that they apply the depreciation. So hope it is clear. They are reducing the full depreciation, sir. Instead of this, what you can do is, you can take the closing balance given in the question. What is the closing balance given in the question of these two? 2,25,000. For this you can add profit on revaluation, that is 1,25,000. You can reduce the further depreciation to be provided because of this. In that way also you will get, sir. Further depreciation to be provided, how much, sir? 12,500 for machinery. So reduce 12,500. So here also, in that way also you will get 3,37,500 only. Even here also, for 42,500, first adjust that loss on revaluation of 12,500, then add back the depreciation to be reversed because of furniture, which is 1,875. In that way also you will get once again the balance sheet value. In both the ways you can compute the asset values. Once you know this, you should know reserves and surplus, sir. Now what is the reserves of holding company, sir? How do you compute it? First take holding company balances. Reserve is how much, sir? 5 lakh. For that add share of whom, sir? Holding company in the post acquisition profits. How much, sir? 1 lakh. This 1 lakh is to be added to the 5 lakhs. You will get 6 lakhs. This is the reserves closing balance. If I ask P&L closing balance, opening balance is how much, sir? For P&L 2,50,000. For that you will add this 11,500. You will get the closing balance, that is 2,61,500. Once you are able to compute reserves and surplus, similarly this PPE and then this goodwill, now the rest of the assets, it's simply line by line addition. So hope everybody have understood how I have done. Sir, is that clear? I have taken little bit of time, but still it is necessary for such a question, because I have given the format which we have followed in our classroom discussions. Usually in our classroom, first we will write a basic data like this, then the classification, then the profit or loss on revaluation like this, then we will start with this minority interest, cost of control, etc. In that way only I have proceeded. So now let us continue our discussion on RTP. Now our issue is with respect to accounting standards. Let us complete the questions in the RTP which are based on accounting standards. Okay, right. AS4 first. T Limited closes its books of accounts every year on 31st March. The financial statements for the year ended 31st March 2020 are to be approved by the approving authority on 30th June 2020. Now this is the year ending, whereas this is the date of approval of financial statements. This is the date of approval. This is the date of books closure, I think I can say. Date of closure, year ending. During the first quarter of 2021, the following events or transactions has taken place. Now what we should do, sir? Maybe we should analyze whether each of these events are adjusting events or not. If it is adjusting events, we have to adjust the financial statements. If it's a non-adjusting events, we have to ignore it. That's all. Okay, right. Now first, T Limited has an inventory of 50 stitching machines costing at rupees 5,500 per machine as on 31st March 2020. There is a company T Limited. It has got inventory of how many machines, sir? 50 stitching machines costing at 5,500 per machine as on 31st March 2020. The company is expecting a heavy decline in demand in the next year. Okay. The inventories are valued at cost or NRV, whichever is lower. During the month of April, due to fall in demand, the prices have gone down drastically. The company has sold 5 machines during April 2020 at a price of 4,000 per machine. Now the point is, sir, previously what they have done is they have valued at cost or NRV, whichever is lower. During the month of April, due to the fall in demand, it has gone down even more. Now the point is, all these fluctuations, shall it be adjusted or not? Tell me one thing, sir, for these changes, will there be any condition existing as on balance sheet date or not is the question. Now please observe carefully. Now what we are thinking, sir, company is expecting a heavy decline in demand in the next year. Already we are expecting that. That means condition is existing or not is the point. Okay. During the month of April, due to the fall in demand, accordingly the goods also have been reduced. Now the point is, at the year end, shall we record at this 5,500 or shall we record at this 4,000 per machine is the point. Hello, at what value we shall record? Is it at 5,500 or 4,000? Usually inventories fluctuations may happen, sir, but because it is very clear that before the balance sheet date itself decline is there and the actual decline is a further evidence, now you can call this as an adjusting event and you can record it at 2 lakhs. Are you getting the point, sir? Usually any inventory fluctuations which happens after the year end will not be considered as an adjusting event, but here because they are expecting in March itself that decline, now we can assume that it is a condition already existing, but to say that condition, it should be a proper evidence, sir. If they are able to justify that evidence only, this can be considered as adjusting. Though ICAI has given an answer like this, to be frankly speaking, usually expectations alone cannot be considered as a proper evidence. On that day, if you have already recorded it proper, whichever is lower, it is okay. And in the question they have mentioned the same. Already the inventory is valued at cost or NRV, whichever is lower. On that day, market price is higher, but in future they are expecting a huge decline. Now as per their expectations only decline happened. It's just like because already existing you are expecting it and it now happened. Condition is already there. It's a further evidence. In that way you can call as adjusting, but otherwise usually no. Here it's okay. You can call it as a adjusting event. Next, a fire has broken out in the company's godown on 15th April 2020. The company has estimated a loss of 25 lakhs, of which 75% is recoverable from the insurance company. Sir, if fire occurred after 15th April, now tell me, for that any condition will be there? No, for fire condition will not be there. So it's a non-adjusting event, but we have to check whether going concern is affected or not, because 75% is already recoverable from the insurance company. Now we cannot say going concern is affected. So thereby it's straight away a non-adjusting event. Hence you need not disclose or do anything. Next, a suit against the company's advertisement was filed by the party on 10th April after 10 days. Now you could observe it was filed after the year end, sir. It's just like a contingency, but to record it even as a contingency, first of all it should be there till the year end, sir. Now there is no condition existing as on the balance sheet date, so it is not an condition, it is not a adjusting event, because case itself was filed when, sir? After balance sheet date. If case was filed before balance sheet date and there was a further evidence, then we can call it as a adjusting event. If the case itself was filed after balance sheet date, then it will not be considered as a adjusting event. Now here it will be considered as what, sir? Non-adjusting event. So hope the discussion is clear. Next. So this is question number 12, sir. Next, AS5. The accountant of Mobile Limited has sought your opinion with relevant reasons whether the following transactions will be treated as change in accounting policy or not for the year ended 31st March 2021. Please advise him in the following situations in accordance with provisions of relevant accounting standard. Okay. Now, what are the points? Let us see, sir. We have to analyze whether the following are change in accounting policy or not. First one, provision percentage changed from 2 to 3. Sir, this is not a change in accounting policy. This is just change in accounting estimate. Next, during the year ended, management has introduced a formal gratuity scheme in place of ad hoc gratuity payments to the employees on retirement. In the standard itself, they have said 2 points specially, that if the transaction is substantially different from the last year, then if you change the policy, that is not a change in accounting policy. For the same transaction, if there is a change in principle, that should be considered as change in accounting policy. Here, previously no proper scheme, only now a proper scheme was derived, then automatically your principle also changes. Now it should not be considered. It is just like the transaction itself is different. If for the same transaction accounting policy was changed, then only change in accounting policy. Next, life was changed from 5 years to 3 years. Life is always change in accounting estimate, but not a change in accounting policy. Next, now management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Such employees will get the pension. Earlier there was no such scheme of pension in the organization. Hello, everybody, sir, previously pension scheme was not there, but now there was pension scheme. Hello, everybody, previously pension scheme was not there, sir, but now pension scheme was there. The transaction itself is new, the scheme itself is new. Sir, if the transaction itself is new, for that if you follow a new accounting policy, then it's okay, sir, nothing wrong. But if the transaction is same and then if you follow different policy, then only it's a change in accounting policy, because the transaction itself is new. For that if you go for a new policy, that is not a change in accounting policy. It is considered as introduction of a new accounting policy, not a change in accounting policy. The last one, change in cost formula, FIFO to weighted average, etc. Now this is absolutely a change in accounting policy, because the method used for applying the accounting principle is said to be changed. So hope everybody have understood. Only the last one is considered as a change in accounting policy. The other 4 are not considered as a change in accounting policy. Okay, right. Similar question we have already seen with similar numbers also in our CRDs. Next, B Limited undertook a construction contract for 50 crores in April 2020. The cost of the construction was initially estimated at 35 crores. The contract is to be completed in 3 years. While executing the contract, company estimated that cost of completion of the contract would be 53. Sir, I think we remember this point where the expected contract revenue is less than the expected contract cost. In other words, reverse, where expected contract cost is greater than expected contract revenue. To that extent, whatever loss is expected, the expected loss can be recognized. Hello, what is that? The expected loss can be recognized. So hope everybody have understood. So thereby that 3 crores you can recognize as loss immediately. I think you will have a special point like this, where the expected cost is greater than expected revenue, that loss should be recognized immediately, irrespective of whether or not work has been commenced, irrespective of percentage of completion, irrespective of the amount of profit expected from the other contracts. The same point we will apply. A simple point only, sir, where it is higher, to that extent the expected loss can be recognized immediately. Next, let me move to next point, AS9, revenue recognition. An infrastructure company has constructed a mall and entered into agreement with the tenants towards license fee. Okay, monthly rental and a variable license fee, a percentage on the turnover of the tenant. Sir, we have given a particular building for rental basis or for license fee. Now, how we are collecting that income? Now, monthly some amount you have to pay. In addition to the monthly fixed fee, some variable portion also will be there. Some variable portion also will be considered. Monthly fixed fee will be there. For that, we will consider variable portion. Together, we will call as the total license fee. Hello, an infrastructure company has given a mall and taking both monthly rentals, that is fixed fee, as well as the variable portion, that is a percentage on the turnover of the tenant on annual basis. Okay, the CFO of the company wants to recognize license fee as income for 12 months during the current year and variable license fee as income during the next year. Hello, what is that? They want to recognize license fee as income for 12 months during the current year and variable license fee as income during the next year, since invoice is raised in the subsequent year. Comment whether the treatment is correct or not. Sir, the question is so simple. Sir, you are getting two types of income, monthly rental income you are getting and some variable portion is there. They are telling because the variable portion is on annual turnover, year should be completed. So invoice also will be raised in the next year. Now the question is, because invoice is raised in the next year, he want to recognize only in the next year. Now I can say, sir, rentals, how you will recognize, sir? I think already in the chapter you will get it. First sale income will be there. Next rental income. How do you recognize any rental income, sir? It is usually for use of any asset. If there is any rental incomes or license fee like this, we follow accrual basis only, sir, as per the agreement. But understand one thing, invoice is raised in the next year. That doesn't mean just because of invoice will we stop recognizing revenue, sir. Please understand, collection should be certain. I think collection is certain only. Amount should be certain. On some reasonable basis, I think you can book. Am I right or not? Provision for tax is there. How you will book, sir? You will estimate some profits and based on that only you will book. Am I right or not? Now I say this license fee also, instead of not booking license fee at all, the variable portion to some extent has to be booked, sir. Ignoring straight away just because invoice is raised in the last year, next year is not correct. Suppose the collection is not certain, suppose the amount is not certain, then it's okay. But just because invoice is raised in the next year, you cannot stop recognizing. Accrual also says if it is related to last year, recognize in the last year only. So I can say in the given question, the contention of chief financial officer is not correct. Recognizing fee as revenue cannot be deferred simply because the invoice is raised in the subsequent period. Just because the invoice is raised in the subsequent period, now we cannot defer the revenue recognition. That is not the sole point of deciding revenue recognition. Look at the uncertainties relating the amount, uncertainty relating to the collection. If it is affecting, please stop recognizing, but only because of invoice you should not, because even accrual also says what, sir? Whenever it is accrued only, last year itself we have earned, no? Why you should wait till the next year? So thereby you can recognize in the last year only on some reasonable basis. So hope everybody have understood. Next, indicate in each case whether revenue can be recognized and when it will be recognized as per AS 9. Trade discount and volume rebate received. Sir, trade discount received, that means at the time of purchase only we will receive it. It's a reduction of cost but not a revenue to us. It represents simply cost reduction only but not revenue. Next, goods are sold to distributors or others for resale. When we are selling to distributors or others for resale, when we should recognize the revenue? It purely depends on the distributors or others, sir. If really, if I can say consignment nature is there, that means if agency relationship is there, when it is sold by the agent to the third party, otherwise immediately you can recognize. Let me observe here, when goods are sold to distributors or others, revenue from such sales can be recognized if significant risks of ownership has been transferred. However, in some situations, buyer may in substance be an agent. In such a case, we have to treat as per consignment sale. In simple, if there are any distributors, observe whether there is agency relationship or not. If agency relationship is there, treat it as if it is a consignment sale. Based on that only, you have to book it. Now, if it is not a consignment sale, then you can recognize immediately if significant risks and rewards are transferred. Next, where the seller concurrently agrees to repurchase the same goods at a later date. I think you might have learned this in AS 9 that this is financing transaction in substance, not a real sale. We are selling a goods, later on we are purchasing the same at a higher price. It doesn't happen usually. It is clearly a financing activity and should not be recognized as revenue. I am not explaining in depth, sir. It is one of the special categories in the case of goods. It is a financing activity but not any revenue. Insurance agency commission, this on the effective renewal of the policies, commencement or renewal dates of the policies, you can recognize the insurance commission. So hope everybody have understood. Is that clear everybody till now? These are basic points only, sir. Here alone be careful. There is slight controversial point here relating to that license fee. I have said you, considering the most favorable, you can recognize as a revenue on some reasonable basis. But if you feel that amount is not so certain at all, then you may not recognize. But I say, when you are there on 31st March, turnover might be clear, no? So thereby you should have recognized something by 31st March. That is what I say. Okay, right. Next, you need not wait till the next year. By 31st March, you can clearly know the turnover. So thereby you can pass it, sir. Not a point. Next, let me start reading question number 15. It is based on segment reporting. Hope everybody is ready. Right. Company A is engaged in the manufacture and sale of the products which constitute two distinct business segments. Hello. Everybody, there is a company, sir, which is engaged in the manufacture and sale of products which constitute two distinct business segments. The products of the company are sold in the domestic market only. Now, where they are sold, sir? They are sold in the local market only. The management information system of the company is organized to reflect operating information by two broad market segments. Now, usually whenever they take a decision, they take in this way, they consider the segments usually as two types. One is rural segment, the other one is urban segment. Besides these two business segments, how should the company A identify geographical segments? And next point is, do the geographical segments exist within the same country? Explain in line with the provisions of AS 17. That is the question now we have to deal. 2 points are there. How many geographical segments are there? First point. Second point, do the geographical segments exist within the same country? Now, first of all, for this, you should know the definition of geographical segment, sir. What is a geographical segment? It is a distinguishable component of an entity. which is engaged in providing a product or a service in a particular economic environment and whose risks and returns are different from other geographical segments. Let me show you. And what is main point is risks and returns should be different to be included in a separate segment. If you feel risks and returns of a geographical segment, two geographical segments are same, then they should be considered as one segment. If the risks and returns are different, you can consider as separate. Now, accordingly, to identify geographical segments, company A needs to evaluate whether the segments reflected are subjected to different risks and returns or not. Whether they are within the same country or not doesn't matter only. Hello? Whether they are existing within the same country or not doesn't affect at all, sir. Country doesn't matter. It is only the risks and returns that matters. So thereby here you can consider them as a separate geographical segment because they are taking it now for MIS. They are taking decisions in that way. That means internal reporting system is happening in that way. That is one of the best way only, sir. Internal reporting is one of the methods available to decide the segments. So these two are the geographical segments we are having. Okay, right. So there will be nothing wrong, sir. Sir, some extra information will be there. You please read it. You will understand. Main point is the same. Next, a company has an inter-segment transfer pricing policy of charging at cost less 10%. Market prices are generally 20% above the cost. You are required to examine whether the policy adopted is correct or not. To be frankly speaking, in AS 17, not even in one place we talk about the pricing, sir. That means at what price segment A should transfer to segment B, or at what price segment B should transfer to segment C. Like that, nowhere standard will discuss about pricing, sir. Hello, everybody, nowhere standard has discussed about pricing, sir. So thereby, if standard has not discussed anything, then it's optional, sir. It's up to you. You can go for pricing in your own way. There are no restrictions on pricing. It can be above cost, below cost, or at cost. But only thing you have to understand is, whatever policy you follow, it is better to apply it consistently. Sir, consistency is required, sir. Hello. What is required, sir? Consistency is required. That is what important. Just, hello, everybody, just transferring at a particular price doesn't, you cannot say that you are not following any policy. It's okay, sir. You can do it. Hope everybody is able to understand. Now, pricing at any aspect is okay. Transfer pricing policy at any price is okay. Only thing is that you have to observe it is followed consistently, because nowhere in the standard they have kept restrictions on the amount. So they have kept restriction on the prices. Now, let me read it. Inter-segment transfers should be measured on the basis that the enterprise actually used to price these transfers. That's all. There is no rule, sir. Whatever they are using, they can mention. That's all. But that should be disclosed. The basis of pricing inter-segment transfers and any change therein should be disclosed. So no problem at all. It can have its own policy, sir. It may be based on cost, below cost, or market price. However, whatever followed, apply consistently. Therefore, in the given case also, inter-segment transfer pricing policy is correct if it is followed consistently. So hope everybody have understood. Right. Next, let me continue, sir. Now this is a 17 question. Next is 18. In respect of a key supplier who is dependent on the company for its existence and the company enjoys influence over the price of this supplier, can the supplier and the company be considered as related parties? Now I think in one of the points you will get like this, sir. There are some parties which are not deemed to be related parties. Hello, there are some points where we say first we will conclude what are related parties, then after giving the relationships we will say one thing, sir. There are some parties which are not deemed to be related parties. one such party is single supplier or customer or like that, franchise or distribute. If you are doing significant business with only one person, just because of that reason you cannot call him as a related party. If he is having any of the relations given in the standard, the 4 or 5 relations given, that is you can consider as a related party. Just because they are a key supplier or a franchisee or a distribute, for that purpose it cannot be called as a related party. Already this similar point we might have discussed in the regular sessions also. So hope it is clear. I'm not dragging it. So main point is same. Just because you are important supplier or customer or any franchise, you cannot be called as a related party. You have to satisfy any of those relations mentioned. Just like being a holding company or subsidiary, associates, that is control should be there, or else maybe you should have significant influence, or maybe relative of the individual having that significant influence, control or significant influence. Like that we are having some 5 relations. If any of those 5 relations are there, you can be called as a related parties. Just because you are key supplier, you cannot be called as a related parties. Next step, define key management personnel in the context of AS 18. So there was a definition for KMP, sir. In KMP, I can tell you 3 words will be there, important words. Just remember that, that is sufficient. KMP are those persons who are having authority and responsibility for these 3, sir. Usually these 3 are important. What are those 3? PDC. P is for planning, D is for directing, and C is for controlling. What is that, sir? Planning, directing and controlling. If you are having the authority and responsibility, usually the big persons in the company like the MD, they only will have the authority to plan anything, to direct anything, to control anything. If they are having authority for all the 3, so it is not sufficient you simply plan, or if you simply direct, or if you simply control. All the 3 should be there. Planning should be there, directing should be there, controlling, who you only should have authority and responsibility. If you have like that, you can be called as a KMP. Usually it is MD, whole time directors, or any other persons in accordance with whose directions board of directors will act, they are considered as the KMP. Just to understand this PDC concept, it is sufficient. So this is AS 18, sir. Now let me get back to AS 19. Classify the following into operating lease or finance lease. I hope you remember there will be some points, sir, to identify as finance lease. 5 indicators will be there. If any of the 5 indicators are satisfied, we will call it as a finance lease. Starting with now automatic transfer of ownership at the end of the lease period. That is the first point. Second point is option to purchase at a very, very lower value. Then the third one, maybe it talks about the period, it covers the major part of the life. Then fourth one, it talks about the value, it covers substantial portion of the present value of lease payments, covers substantial portion of the fair value. Last one, the asset is of specialized nature. If any of these conditions are satisfied, indicators are satisfied, we usually call it as a finance lease. Otherwise it will be called as what, sir? Operating lease. Will apply the same. First one, they have given MLP is X, fair value of the asset is by X equal to Y. I have said if present value of lease payments is at least substantially also, it is finance lease. Here they are telling X equal to Y. Easily that will be considered as a finance lease. Next, life is 7, lease term is 6.5. Here also major period is there, no. But asset is not required, sir. Even if one indicator satisfied also sufficient, we can call it as a finance lease. So definitely this is considered as a finance lease. Next, economic life of the asset is 6 years, lease term is 2 years, but the asset is of special nature. I have said you, even if the asset is of specialized nature, then also we will call it as what, sir? Finance lease. Once again, this will be considered as finance lease. Now, next question. This is based on sale and lease back, sir. Viral Limited sold machinery having WDV of 40 to Saral Limited for 50 lakhs and the same machinery was leased back by Saral to Viral. Okay, Viral. Right, the lease back is in the nature of operating lease. You are required to explain the treatment. Sir, we usually divide like this: sale and lease back. When it is there, it may result into finance lease or it may result into operating lease. If it is finance lease, straight away we say that profit or loss is to be deferred, because we feel that usually the transaction might be fraudulent in the case of finance lease. We will not allow them to recognize profit or loss now itself. We will ask them to defer. If it is operating lease, we divide into three scenarios. One is sale value equals to fair value. In that case, profit or loss will be recognized immediately. This is the first scenario. Here profit or loss you can recognize immediately. Second scenario, sale value is greater than fair value. In such a case, up to fair value we can recognize immediately. If there is any profit up to fair value, in excess of fair value if there is profits. So two things are there: up to fair value, if profits are there, recognize immediately. Recognize immediately. In excess of fair value, if profits are there, you please defer it over the period. This is what second scenario. The third one, if sale value is less than fair value, in such a scenario, what we usually do, sir, if it is giving losses, if it is giving profits, we feel it's genuine only, profit or loss can be recognized immediately. If it is losses, then we observe whether it is compensated by future concessional lease payments or not. If compensated, that means some fraud might be there. We will not allow them to recognize immediately. We have to postpone. If compensated by future lease payments, profit or loss should be deferred. If not compensated, profit or loss can be recognized immediately. Sir, if nothing is mentioned, we will assume positively. That means it can be recognized immediately, because sometimes they may not mention about this, sir. But let me tell you one thing, sir, all this discussion takes a minimum of 1 hour in the class to explain this. I am not explaining, I am just giving you the principle and apply it, sir. I cannot explain you entire conceptual issues here. I am just simply showing you reminding you how we should deal. Now, in the given case, book value is 40, sale value is 50 lakhs. Okay, first scenario, fair value is 45, sale price is 39. Tell me which scenario, sir? Sale price less than fair value or equal to or more than? Sale value is less than fair value. Now immediately look after whether you are having profit or loss. What is the book value, sir? Book value is 40 lakhs. That means, are you having profit or loss? I think please understand, you are having a loss. That means you can recognize immediately on the assumption that it is not compensated by future lease payment. You can recognize immediately on the assumption that it is not compensated. Now next, fair value 40, sale price is 49. Then what we can do? What is the profit? Book value is 40, sir. Fair value is also 40. To the extent of fair value, you can recognize immediately. Anything in excess, what is that? 9 lakhs. For this 9 lakhs, we have to defer, sir. That 9 lakhs profit has to be deferred and amortized over the lease period. Next, fair value is 46, sale price is 50. Here also more, but the book value is 40. So thereby 6 lakhs you can recognize immediately. 4 lakhs has to be deferred over the period. The same we are doing, sir. 6 lakhs we can recognize immediately. 4 lakhs has to be deferred over the period. In this way, we have completed AS 19. First, we will start with AS 20. Right. Sir, actually, what we are going to learn now is not CA inter level. To be frankly speaking, in every standard, something can be asked in CA inter level, something is beyond your level, that is CA final level. Actually, these issues in EPS, we usually deal in CA final, but sometimes when they give any RTP or MTP, because it's accounting standard, they'll simply take from CA final any old syllabus FR and they'll put it in the RTP. Here also they have done the same, but anyway, we will try to learn it whenever it is given there in any RTPs or MTPs. Let us not take that excuse, and now we will simply learn whatever given in the standard in this RTP. Let me read the question carefully and explain it. So everybody please listen well. This is a new question to you altogether. Now, so listen well. Stock options have been granted by AB Limited to its employees, okay, and they vest equally over the 5 years, that is 20% at the end of each year from the date of grant. The options will vest only if the employee is still employed with the company at the end of the year. Now, what they are telling, sir? Here it is very simple. They want to communicate that, sir, you should continue over 5 years. If you continue over 5 years, at the end of every year, you will get 20%. It's like a graded vesting in our ESOP chapter. Do you remember, sir? In our ESOP chapter, we'll have something called as graded vesting. What is graded vesting? All the options will not vest at the end of a fixed period. Every year, some options will vest. That is what graded vesting. Okay. Now, if the employees leaves the company during the vesting period, the options that have been vested can be exercised while the others would be lapsed. In other words, suppose out of 5 years, you have continued till 3 years. That means all these 3 years options can be exercised, but these 2 years cannot be exercised. It will be considered as lapsed. That is what they are telling. Currently, AB Limited only includes only the vested options for calculating diluted EPS. In other words, for computing diluting EPS, they are considering only the options which are vested, and they are not considering the options which are not yet vested. Should only completed vested options be included for computation of diluted EPS? Is this in accordance with the provisions of AS 20? Explain. Now, let me give you one clarity, sir. I think whenever you have learned that dilutive EPS, 3 such instruments we usually deal is 3 instruments. There will not be corresponding increase in resources, but increase in number of shares will reduce the EPS. So, what are that instruments, sir? One is convertible debentures, the other one is convertible preference share, maybe the third one is options. Do you remember that, sir? What is option? Nothing but your ESOP. ESOP only. In the case of ESOP, you are giving the employee to purchase the share at a very, very concessional price. Am I right or not? That concession portion is considered as the considered for our diluted EPS purpose. Maybe entire entire option will not be considered. That concession portion will be considered for our dilutive EPS. Now the question is, shall we consider that concession portion for all the options? That means the options, suppose this year we have given 1000 options. How it will vest, sir? Every year 200 options. Now for our diluted EPS purpose, shall I consider all the 1000 options, or after completing first year consider 200, after completing second year another 200? Shall I proceed like this? Sir, diluted means chance is there that in future they may convert. So thereby there is no distinguishment whether they are vested or not yet vested. We have to consider entire 1000. That should be your answer. Have you understood what I am telling, sir? It is potential equity shares. Nowhere we are telling that they should be vested, sir. If it is potential equity share, it is sufficient. So thereby let me tell you, the current method is not correct. The calculation of diluted EPS should include all potential equity shares, that is all the stock options granted at the balance sheet date which are dilutive in nature irrespective of the vesting pattern. All the options should be considered in future whether they may vest or not. Today if you are there, all the options should be considered. So there will only vested should be considered. In future they may vest or not. Like that you should not consider, sir, because you are feeling potential possibility is there that they may convert into equity shares. We'll assume that all the options will convert into equity shares. Hence, you telling that only those options which are completed will be considered is not a correct one. So, hope everybody have understood. Next. Second one, another important point, sir. Please observe that. X Limited as at March 31st, 2021 has income from continuing ordinary operations of 2,40,000, a loss from discontinuing operations of 3,60,000 and accordingly a net loss of 1,20,000. What they are telling, sir? There is an organization, it has got operations, sir. In AS24, I think you should know the operations existing are divided into two. What are the two, sir? Whatever operations we are having, we will divide into two. One is continuing operation, the other one is discontinuing operation. Hello, what is that? One is continuing operation, the other one is discontinuing operation. Now, here also same, sir. Now, they are telling for continuing operations, what is the profit they are having, income they are having is 2,40,000. Whereas for discontinuing operation, they are having a loss of 3,60,000. Overall, they are having a net loss of 1,20,000. This is what they are communicating. Okay, these are the facts. Now then what is the issue, sir? The company has 1,000 equity shares and 200 potential equity shares. Potential equity shares means they will be considered for which purpose? Diluted EPS. Okay. Now, first of all, when they say potential, due to that, when do we consider for diluted EPS, sir? If due to that potential equity shares, what will happen, sir? EPS should dilute. Once those are converted into equity shares, will the EPS dilute or not is the point. At present, how many shares are there? 1,000. So, can I write like this? Earnings per share may be either positive or negative. 1,200 by 1,000, which is 120 negative. Am I right or not? Suppose if I include that potential equity shares, what will happen? 1,200 divided by 1,200. Now it will become 100 negative. Sir, EPS reduced. EPS means profit, earnings should be reduced. Here what happened? Loss reduced. Is it dilutive or anti-dilutive? It is becoming what, sir? Anti-dilutive. So shall I consider this for my diluted EPS purpose? The answer is no. Like that you please don't feel, sir. In this way, you cannot check for diluted EPS. Why, sir? Sir, whenever you are having loss, the same scenario will repeat whatever the potential equity shares may be, though they are dilutive. That's why standard has said clearly one point. For checking whether potential equity shares are dilutive or not, for checking whether potential equity shares are dilutive or not, for that purpose, first please don't consider this discontinuing, only consider continuing, because there only you will have profits. In such a scenario, can you please tell me 2,40,000 by 1,000 means initially how much? 240. If you include that 200 also, it becomes 2,40,000 by 1,200. That is how much, sir? 200. Now decrease in EPS was there or not? Yes. So here they should be considered as dilutive. Sir, they say only one point. To decide whether it is dilutive or anti-dilutive, observe only continuing operations and not discontinuing operations, because in the case of discontinuing, usually you will have losses, sir. That's why only you are discontinuing. When you are having losses, when number of shares are increased, loss will always reduce only. For that purpose, you cannot say it is anti-dilutive. So thereby standard itself has given that clarity, telling that when you should decide whether it is dilutive or anti-dilutive, don't take discontinuing, take only continuing. This is the discussion done in the standard. So accordingly we should answer. Let me read the solution for you, you will get clarity. As per AS20, potential equity shares should be treated as dilutive when and only when their conversion into equity shares would decrease the net profit per share from continuing ordinary operations. Please observe carefully. We should observe only what, sir? Continuing ordinary and not entire operations. As income from continuing operations is 2,50,000, only will be considered and not 1,20,000 for ascertaining whether the 200 are dilutive or anti-dilutive. Accordingly, 200 would be considered as dilutive since their inclusion would decrease net profit from 240 to 200. Thus, the basic EPS will be negative 120 and dilutive EPS will be 100. Sir, that is just for the purpose of checking. Once the checking was completed, you will do it for an overall basis only. That computation of basic and diluted will happen for entire organization only, continuing plus discontinuing together. But just to decide whether that potential equity shares are dilutive or not, we will consider only continuing operations. So, hope everybody have got that clarity. Next, let me move to AS22, sir. The following transactions were reported by PQR Limited during the year 2021. Tax rate was given, there were some items, okay. Now, you are required to show the impact of above items in deferred tax asset or deferred tax liability for the year ended 31st March 2021. Let me read one by one. Items disallowed in 2019-20 and allowed for tax purposes in 2021. So, please observe carefully. In accounts, we should compare, sir, what is done in accounts and what is done in taxation. In accounting, in 1920, allowed or disallowed? Allowed. Where it is disallowed? Taxation. In 2021, because in 1920 only accounting it was allowed, once again it will not be there in accounting, but here this time it will be allowed. Now tell me one thing, overall it was allowed as expense in both accounting and taxation or not? Yes. So thereby is the timing difference, permanent difference? It's only timing difference. So thereby first year, when you have recorded only expenses in accounts and it was disallowed in tax, so expense not recorded means profit, taxable income could have been higher, due to which you might have paid more tax. As a result, what might have been created? DTA might have been created. Now we will call this as reversal of DTA. Last year DTA might have been created. So thereby here we will call as reversal of DTA. Amount into tax rate, you will get the amount of DTA to be reversed. So hope everybody have understood. Next, interest to the financial institutions accounted in the books on accrual basis, but actual payment was made before the due date of the filing return and allowed for tax purpose also. You should know one thing, sir, in books of accounts, in the current year only it will be allowed. In taxation also it will be allowed, provided that interest is paid before the due date of filing of return for this year. Suppose it was paid after the due date of filing of return, then it will not be allowed in this year, it will be allowed only in the next year. That is what the provision. Now because it was filed before the due date of the return, it was paid before the due date of filing return, so it will be allowed in taxation also same year. So please understand, in accounts also allowed, in taxation also allowed, same year only. So thereby difference itself is not there, hence no difference at all, so nothing is applicable. In the both the cases it was accounted for in the same year. Next, donations to private trust not allowed in income tax. Whereas in accounting allowed or not? Yes. So thereby difference is there, but this is which difference? Timing permanent. This is permanent because never in taxation it will be allowed. For permanent differences we will not create any DTA or DTL. This is permanent difference. So hope everybody have understood. So with this question number, of course, question number 19 also completed, that is relating to AS22. Next, AS24, discontinuing operations. What are the disclosure and presentation requirements of AS24 for discontinuing operations? I think you remember in our standard at the end we will have the disclosure requirements, sir. Almost 8 requirements will be there. Description of the DCO, that means what is the mode of discontinuation, you should explain it, whether it is sale in entirety or piecemeal or abandonment, like that you should mention. Similarly, which segment is getting stopped, is that a business or a geographical segment or a sub-segment? Similarly, when initial disclosure event has happened. Similarly, what is the expected date of completion of discontinuance, like that you should show some basic details. After showing like this, relating to that asset, relating to that segment, financials we have to show. What are the financials? carrying amounts of the assets and liabilities, then amounts of incomes and expenses, then pre-tax profit or loss from ordinary activities. Then similarly, net cash flows from operating, investing and financing. Like this, some finance related issues of that particular discontinuing operation also has to be shown. So these are the disclosure requirements. They are asking, give 4 examples of activities that do not satisfy the criteria of paragraph 3 of AS 24. Now I think you remember, we will say specifically that some are not DCOs, some are not discontinuing operation. Those things we should explain. That is gradual phasing out of a product, sudden discontinuation without any plan, then shifting from one location to another location, closing out a facility to achieve savings. These things we usually learn, sir. The same 4 points we have to write here. That's all. Next, with this AS 24 I am closing. Now let me move to AS 26. Everybody, PQR Limited has acquired a brand from another company for 100 lakhs. PQR Limited contends that since the said brand is a very popular and famous brand, no amortization needs to be provided. Sir, can we say that we are having a great brand, it will have unlimited life, as it is having unlimited life, amortization is not required. Can I say like that? No. Standard clearly says any intangible assets max you assume that the life doesn't exceed 10 years. So you cannot say that amortization cannot be done. So you have to do the amortization. AS 26 provides that intangible assets should be measured initially at cost. When they say at cost, that cost should be systematically allocated over its useful life. And the standard says there is a rebuttable presumption that useful life cannot exceed 10 years. In the case of brands, we cannot prove that. Definitely it will have a life exceeding 10 years. So you have to take the life as 10 years and you have to amortize it over the 10 years. You assuming that it will have a whole life, unlimited life, and thereby will not amortize is not a correct discussion. Right. Next, part B. X Limited is engaged in the business of newspaper and radio broadcasting. It operates through different brand names. Okay. During the year ended 31st March 2021, it incurred substantial amount on business communication and branding expenses by participation in various CSR initiatives. The company expects to benefit by this expenditure by attracting new customers over a period of time, and accordingly it has capitalized the same under brand development expenses and intends to amortize over the period. So please understand, they are doing some CSR activities, they are doing some branding expenses. Now all these things they want to create an intangible asset. Tell me which intangible asset you will create first of all. Which intangible asset you will, forget about life and all, which intangible asset you will create, sir? Please understand, you cannot create any intangible because these like some heavy advertisement expenses you incur. When you incur heavy advertisement expenses, can you say FAB is probable? No. So when FAB is not probable, how can you say we can recognize any asset? For recognizing any intangible asset, recognition criteria will be there. 2 recognition criteria. One is FAB should be probable, other one cost should be reliably measurable. So thereby, in this scenario, FAB is not probable. Just because you incur expenses, can I say FAB is probable? No, sir. Maybe you may get new customers, but that is not pakka, that is not definite. We cannot prove it, sir. So thereby, what we can say, intangible asset itself will not be created. So there is no discussion of amortization. So let me tell you, an intangible asset should be recognized if and only if it is probable that FAB should be if and only if it is probable that FAB is there and cost can be measured reliably. In the given case, no intangible asset is acquired or created that can be recognized. So thereby, we cannot recognize anything. The same should be charged to P&L. It cannot be amortized. When it can be amortized, if it is an intangible asset, then slowly you can amortize. It's just a heavy advertisement expenditure you incur. You have to charge it to P&L. Next, AS 29. Kavos Limited is in the process of finalizing its accounts for the year ended 31st March 20. Okay. it seeks your advice on the following cases. Cavos Limited has filed a court case in 1415 against its competitors. Okay. It became evident to its lawyers during the year 31st March 2020 that Cavos Limited may lose the case and would have to pay 3 lakhs being the cost of litigation. No provision was created. Sir, tell me when provision will be created? It will be created if it is satisfying 3 conditions. There should be a present obligation, it should be arising from a past event, hello, and similarly there should be an outflow of resources. In such a case, you will be recognizing, of course, a reliable estimation of the amount also should be made, then only you will be recognizing. In the first scenario, you could observe, is this a present obligation or not? When it is a present obligation, sir, if the probability of losing is greater than 50, here it is very clear that it is a present obligation. So, other things are also known, amount is known clearly, so everything is known, so thereby you can create the provision. Next, a new regulation has been passed in 1920 by the Healthcare Ministry to upgrade the facilities. Deadline set by the government is 31st March 2021. The company estimates an expenditure of 10 lakhs for the said upgrade. Tell me one thing, shall we create provision now or not? Sir, I think similarly you will get one question also where you should set up any device or you should set up anything ready in your factory, fire extinguishers or etc. Please understand one thing, when the deadline is set, sir, 31st March 2021, when you are there 31st March 2020, by this time is there any present obligation? No. Now tell me, is it definite that you should upgrade your facilities? Understand one thing, I may say in future, I don't want to continue this business, then can you say, Pakka, definitely you should do this? If you want to continue your business, only this is required, sir. So, different ways of escaping is possible. Suppose I have continued the business and I have not upgraded. What is definite? Penalty is definite. Suppose 3 years I have continued, sir. Nobody asked me. Suppose somebody observed later, what they will ask? Penalty. Once this 31st March 2021 is completed, then I will create provision for penalty. For the time being, for this year, we don't require to pass any entry. There is no obligation. So, it's just like we'll be having one example whereby because of law we need to install smoke filters. Similar example. So, thereby no obligation is there, hence no provision is required for this year end. Maybe in the next year end, if there is any penalty for that for not upgrading, then we may recognize that. For now, there is no need to recognize anything. Next step, company gives 1 year warranty for its healthcare equipment under the contract of sale that it will make good any manufacturing defect by repair or replacement. As per past experience, it is probable that there will be 1% such cases and estimated cost of repair or replacement is estimated at 10% of such sale value. Company has made a sale of 5 crores. 5 crore sale, how much is estimated? 10%, that means 5 lakh may be the sale value for which repairs may be there. What is the percentage? 1%, that means repair expenses may be 5 lakhs into 1%. In that way we can compute, sir. Provision is required. This is a pure example of warranty. In the case of warranties, provision required or not? Yes, there will be a present obligation. Past event sale is there, and based on the past experience it is probable, thereby only we say it is present obligation. Amount also we can estimate, hence you can create the provision. So that is 5 lakh into 10%, 50,000. 1% chance is there that they may come for repair, sorry. So 5 crores into 1%, 5 lakhs into 10%, 50,000. In that way you will compute the amount. For that amount you should create the provision. A simple case of provision, sir. Provision for warranty required. That's all. So in this way we have completed all the questions. That's all. In group 2 we are having more standards, sir. So there, of course, 1 or 2 good questions are also there. Thereby I have taken a little bit more time with respect to standards. Hope everybody have understood. That's all. With this RTP discussion is completed. Prepare well, sir, for the examination. Thank you. Bye-bye.